but also continuing to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
You can tell the year is over based on the amount of engagement this is getting. Keith Grossman, president of Time, just texted me, Tom.
Small magazine.
I've never seen Titanic. Figured it was a waste. I knew how it ended. You ever seen Titanic?
Seen Titanic a million times.
Oh, you've seen that one.
The screenwriter came home and she was, I think, 9 years old, and she came out to the car and goes, "Dad, the boat sank."
And then he couldn't find space on that door, which clearly there was space on. I never understood that.
No,
you know, Leonardo DiCaprio was asked about that. Couldn't he have found some space on that piece of wood and held on?
Yeah, I'm a big fan, and I remember when he was unknown and early in the movie, the way he read script was an act of God. Just incredibly gifted.
Question comes in on Twitter. Ivan the K, has Tom seen Trading Places? And I've said if you haven't seen Trading Places, this relationship is over.
No,
have you seen Trading Places?
If it's the same movie, there's a scene with Jeremy Irons at the end of the table. I don't know what movie that is. And Irons just absolutely nails it.
With Eddie Murphy?
No, I can't remember. I can't.
You're thinking of Margin. You think of Margin Cool?
Yeah, that's
what he says, talk to me like I'm a
I
Labrador.
haven't seen the movie, but yeah. But he nails the body language.
So you haven't seen Trading Places? Okay.
No. Oh, no, I have. That's Eddie.
Yeah.
Murphy.
Yeah, you seen that one?
Yeah, I've seen that.
Okay, good. I'm going to get you some price
What
action.
is this, Rotten Tomatoes?
I'm just going to work through this slowly. I'll get your review later.
You're killing me.
Equities unchanged on the S&P. Four-day
Tokyo's
losing streak.
blowing up, and we're talking movies.
Over the previous 4 days, the S&P 500 down around about 5%. To close out the year, does it get any better? Futures, just about unchanged. In the bond market, nothing about this market right now is unchanged. Up 7 basis points on a US 10-year, 365.84. And check out the Japanese 10-year. This is the epicenter of the price action. So the 10-year had a cap of 25 basis points. Now we've got a range for yield curve control at the BOJ. They've made a shift. It's from 0.25 to 0.50. And right now, Tom, we're trading at 0.40 on a 10-year. That is a big shift from this Bank of Japan.
We're going to have
overnight.
much more for all of you on this. This is really, really important with international ramifications. And through the morning, we will be touching upon this historic move by Mr. Kuroda. So I think it'll be interesting.
Need to talk about these historic moves in this equity market as well. The U.S. equity market on track for the worst year since the financial crisis. We caught up with Morgan Stanley's Mike Wilson just yesterday. He's sounding bearish about the year ahead.
We're looking for an earnings recession that could be as big of a surprise to the market as it was in 08. Now, what we're not looking for, and I'll make it perfectly clear on this, is a balance sheet recession, a systemic risk fall off like we saw in the fall of 08. So it's very distinguished, but it doesn't mean that there's still not a lot of price risk here.
Did you hear what he said yesterday? That we could test 3K? We could get to as low as 3K.
Doug Cass really pushed back.
In his note, we remain decidedly in the 3,000 to 3,300 camp with a bias towards the low end, given our view on earnings. Then ultimately sees a rally back from that. But that's the downside in early 23 that he's looking for.
He's on top of it. Everybody's got an opinion. But Mr. Cass, I think Doug Cass is looking at it more as a more short-term view than the official Morgan Stanley view. But Cass just says the gloom that's out there is tangible, and he's got to cut against it with some enthusiasm as well. We're going to get a perspective on this in the equity markets. I've got a bunch of questions for Liz Ann Saunders, Chief Investment Strategist at Charles Schwab. Let's just go to that continuum right now, Liz Ann. Are you gloomy like Morgan Stanley, or are you more optimistic like Mr. Cass of Seabreeze?
You'd have to qualify that with a time horizon. I think we're not out of the
Schwabian
woods.
3 years. Schwabian 3 years.
Oh, well, if you give me a 3-year time horizon, I'm almost always going to be optimistic. I think.
Right.
First of all, to quote Chuck Schwab himself, investing by its nature is an act of optimism. And if you have a long enough time horizon, you ought to be optimistic, or you probably shouldn't be an investor. And it is funny. We wrote our 2023 outlook a few weeks ago, and when you write outlooks, you're forced to put it in calendar year terms, even though the market doesn't care a lick about the calendar. The economic cycle doesn't care a lick about the calendar. So it was more of a weaker first half, stronger second half, but I don't know if it works out as cleanly as that. I would agree with Mike Wilson. I think the deterioration in earnings estimates for 2023 is somewhat already under the way. You were up at around 250 or so in dollar terms. You're now down to 230. But I think we're probably moving to well below the estimate for 2022, which is 218. So
Right.
I think very soon we're going to be in negative year-over-year growth territory for earnings, and I think there's more downside than upside there.
Lizanne, I look at exponential moving averages, 3 of them, and they've come to a point for the first time since 2018. It really shows a market with some form of moving average study that's in the doldrums as well. How should individual investors, and particularly with retirement plans, invest given doldrums?
Well, it depends on who you are as an investor. The one beneficial thing that's happened throughout this very tough year where you lost money both on the equity side of things and on the fixed income side of things is that you actually have income in fixed income now. You guys talk to my colleague Kathy Jones all the time, and I think there's opportunity for those investors that are income oriented to not have to be way out the risk spectrum like they were forced to be when you were in a ZERP kind of environment. I also think with the return of the risk-free rate, price discovery is kind of back in vogue. Fundamentals are getting reconnected to prices, and I think the biggest leadership shift that has happened this year is not so much tech to energy, but it's been mega cap to the average stock. And I think that active is operating on a more level playing field with passive. Equal weight outperforming cap weight. Factor-based investing makes a lot of sense. So for the equity-oriented stock pickers out there, those would be the areas I would focus on. Take more of a factor approach than an index approach.
This is really important, folks. And Stuart Kaiser of Citigroup alluded to this yesterday, is when you get into these doldrums, your choice set comes down, comes down, comes down. Is there a value, Lizanne, to a more focused, less diversified approach?
Not necessarily. In fact, if taking an active stock picking approach, you're actually moving away from some of the concentration and lack of diversification that comes when you take a more passive approach. I also think that there's an opportunity here to allow for international representing actually a diversifier, again, speaking specifically of the equity side of things. And not that one quarter that isn't even over makes a trend, but MSCI EFA is pretty handily outperforming U.S. averages. This is not a message to dump all your U.S. equities, back up the truck and load up on international, but either from lack of rebalancing or just recency bias, I think investors have not been at all exposed, or maybe only to a minor degree. And I think there may be an opportunity for diversification both within the equity asset class, but also externally with some non-U.S. exposure as well.
Lizanne, I'd love to talk about this a little bit more. The recency bias, I think we've all been conditioned by the US outperformance and mega cap tech outperformance of the last decade or so. When you have this conversation with clients at the moment, Lizanne, just how receptive are they to this message that you're trying to send?
They're receptive when you actually give them the details of how cycles work. And when you go through what I like to call a dual cycle, where you have a bull market, you go into a bear market, you eventually pull back out again. If there is a corresponding overlapping recession, and let's just posit we're either in one, I think we're in a rolling recession, or we're going to get one, that's a dual cycle. When you come out of those dual cycles, you've never not seen pretty meaningful leadership shifts. And one of the key ones that you see is U.S. versus non-U.S. And we think the setup may be there for some non-U.S. So when you show the data and history and charts and how cycles work, there's a little more up and down nodding of the heads. But initially, it's more of U.S. is the only place I need to be.
It's going to take a while, isn't it? Lizanne, this was brilliant. Just one of the best. Lizanne Saunders there of Charles Schwab. And shout out to Kathy Jones as well. Kathy's just excellent. Fantastic team over there.
Well, and what they do, and this is the legend of Lizanne Saunders, who started out on Wall Street when she was 12 years old. But the bottom line here is they have the courage, John, to think a longer-term perspective and yet give the short-term vicissitudes of it. I won't say that Ms. Saunders invented that, but she certainly carried that heritage forward.
It's a difficult message to sell.
It is.
To a US
and the
investor.
media wants short-term. The media wants,
I think a US investor, Tom, that's been rewarded by the last 10 years just to be long US equities, be long the cap-weighted index, because it's delivered big time year after year after year for most of the years of the last 10.
Yeah, I mean, it's going to be fascinating to say the least. John, I want to talk about the storm that's coming here. This is going to get in the way of the holiday and all. And John, I've done the luxury here. The surveillance team in the control room has translated this into Faro. Chicago with wind chills, literally serious wind storm, negative 34 degrees C. So that's
You're willing
like
to call
cold.
that cold?
That's cold.
Okay, you're willing to call that
that's
cold.
That's dangerous cold.
Oh,
and
please, we clean
this
that
is
up.
a storm coming. I don't think we're going to see much of it in New York. Rob Carolyn can brief us on that later. But this is the real deal. I mean, I have trouble with people accentuating winter, but this time around, it's more than winter. It's like, seems to be the real deal.
What about Europe? You've been checking the weather there? Because that's going to be a big, big issue going into early next year. Europe's ability to refill the gas storage capacity, get it back up again through spring, through summer, going into winter.
I mean, overnight there was some bombing across the Russian border by Ukraine, and it seems to be heating up a little bit, even with winter. It's supposed to stop in winter. That's the history. But I think with modern technology, that history's out. Drones don't care if there's snow.
Hey, you've been great on this.
You know,
there's still a war in Europe.
I'm sorry.
But the 23 outlooks, when we have these conversations, how often is that coming up? I don't hear it that much at all. In fact, if you ask people what changed in the last 12 months, what happened, people would point to that and say that was a shock. We didn't anticipate it. But when we look out to 2023, it's not a big enough feature of the conversation for me, and I don't think it is for you either.
We're going to feature this a couple times this morning. This is Chart Banner. Thank you so much for bringing this up this morning. This is one quick way to show how Powell is different from Kuroda. I really can't convey enough. John talks about it. You know, the real yield is a wonderful property of John Farrow. And on radio, all you need to know is Powell prosecuted a real yield from a negative 1%, and we popped up to positive 1.48%. I look at normal as 2.05-ish. And Japan took a road not taken, John, somewhat the same trend, and then down with a massive negative real yield in Japan, just showing the artificiality there. And again, Powell's success, Kuroda challenges.
So we'll talk more about this a little bit later, but the firms that were short the JGB, the so-called widowmaker, that have been rewarded by what's taking place overnight, Schroders and Blue Bay are two of them. Those two firms, what's interesting for me, they're sticking with the short. So when we ask the question, do you believe this is a step towards normalization, or is this just about a reset from the BOJ to stick with something a little bit more sustainable? I'm hearing more and more from people who think it's the former and not the latter. And the fact they're not closing out those shorts and willing to stick with them through this is interesting.
The chart I did a nominal GDP back to 1982. Kit Jukes goes back to 1973 and says yen right now is as basically weak as it's been in 50 years.
Equities unchanged on the S&P. I go back to what I said 40 minutes ago. I would not have said equities would be unchanged off the back of that move from the BOJ.
Yes,
but they are.
No question about it.
Tina Fordham, the geopolitical strategist and founder of Fordham Global Foresight, is going to join us next.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. After a 17-month investigation, a House committee has recommended Donald Trump be prosecuted for his role in the January 6th assault on the Capitol. It's now up to the Justice Department to decide whether to hold legal proceedings against the former president on 4 criminal offenses, including insurrection. Another House committee is scheduled to meet today to consider publicly releasing 6 years of Trump's tax returns. Negotiators in Congress have agreed to a $1.7 trillion spending bill. Now they'll try to send it through to the House and Senate to avert a government shutdown on Christmas Eve. The bill provides funding for government agencies through next September. It also includes more than $45 billion in aid to Ukraine. China is adding weight to the speculation that it's hiding the true picture of how many people have died since the end of the COVID-0 policy. Health officials confirm they have narrowed how they define a death caused by COVID. Only those people who tested positive and died of respiratory failure will be considered a virus death. In Los Angeles, a jury has found disgraced movie mogul Harvey Weinstein guilty of rape and sexual assault. Weinstein was convicted of abusing only one of the 4 women in the case. Still, he could get up to 24 years in prison. Weinstein is already serving a 23-year sentence in New York for rape and sexual assault. President Biden condemned what he called the violent venom of anti-Semitism. At a White House Hanukkah reception, the president said he understood the concerns of Jewish Americans and that his administration would stand with them. According to one report, anti-Jewish incidents in the U.S. reached an all-time high last year. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
When I started, I had no idea it was going to turn into this. It's a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Do we think that this is just an isolated move? Absolutely not. This is the beginning of normalization. They've been increasingly struggling to hold, their hard policy mix, the emergency policy mix. That's now sort of changed, and we're on the pathway to normalization, and the market is going to be pretty volatile as we progress along that path.
That's a big call from someone who was dead on. That was Russell Matthews, the lead portfolio manager at Blue Bay. Blue Bay was short JGBs, looking for a shift of that cap on 10-year government bond yields, and we got a shift overnight. The Bank of Japan shifting yield curve control from 0.25 to a range, Tom, of 0.25 out to 0.50.
Right.
We're about 40 basis points on a Japanese 10-year this morning. And I go back to what we talked about a little bit earlier on. There is a difference here. Do you view this as a step towards normalization? Win Thin at Brown Brothers Harriman 40 minutes ago says yes. He thinks they're going to hike early next year. Or do you believe this is just a reset to make a dovish policy stance that a little bit more sustainable when the rest of the world is hiking? And you've got to take your pick.
I'm going to go back to first principles here for people. There's a monetary process you go through, and yeah, ECB is different than the Fed, et cetera, but everybody's pretty much, John, on the same theoretical page, given coming out of a supply oddity called a pandemic. Japan took a different road. They read their Robert Frost and took the road not taken. It's original, and every single expert says it's flawed.
Well, you heard it from Blue Bay there. They think this is the road, another step on that road towards normalization. You've heard the same thing from Schroders overnight. This is the quote from them. The market will now pressure the BOJ. We are adding to our short position and building our position in yen. This has more legs. We're on it. There's this belief, and you're going to hear this phrase a few times today, that the genie's out of the bottle. That move today from the BOJ.
Yes, it's very apt to say the least. We're going to give you much more on this through the morning. You know, we're making some lightness here about movies and that and the holidays. Guess what? This is a huge deal, the action of Mr. Kuroda in about the 1 a.m. hour last night. We have experts on this, and one of them with a geopolitical perspective is Tina Fordham. We are fortunate to rip up the script with Ms. Fordham this morning. Tina, I want you to haul the Bank of Japan oddity back to what it means across the Atlantic. What does Kuroda's action to finally nudge towards normality mean for Lagarde and Powell and Bailey? It's got to be a more restrictive, they've got to have support now in their dynamics of restrictive to perhaps accommodative down the road.
Good morning, Tom and John. I'm not sure I necessarily agree with that. I mean, of course, I don't make interest rate calls, but if we think from a global macro perspective, sitting here in Europe, it is still not looking like normalization time or feeling like normalization time. And so you're right that Lagarde and Jay Powell have some cover coming from the Bank of Japan,
Right.
but I think that the worries feel a lot more acute, particularly speaking from the European perspective. And that sort of brings it back to what you won't be surprised to hear me say, which is the extent to which geopolitics is now the main driver of the economy and the investment environment.
I strongly agree with that. Help us with the geopolitics that Christine Lagarde has with a war that is basically unmentioned in economic talk, economic babble. I don't fault her for that. But overlay a continued war, overnight Ukraine, I believe, attacking over the Russian border, overlay your war over into the challenges that Christine Lagarde has.
The difficulty is that central banks don't explicitly, of course, incorporate geopolitical criteria into their analysis, which is why you're not hearing too much talk of it. But of course, it's not only the elephant in the room, it's the most difficult to price variable with a constellation of factors that they're looking at. I think I would say we've been lucky so far that Russia hasn't escalated and used unconventional weapons. We know that it's still a potential risk. And then, as you mentioned, Ukraine is being told every day not to fire over the border. But the next few months are going to be, in many ways, the worst of this conflict from the point of view of the humanitarian impact. And as we know, it's been the morale in Ukraine that's allowed them to carry on fighting and gain, what has to be a modest advantage. So I've been reading all of the analyst reports, just like you guys, and to me, everyone's too sanguine about how most of the bad news is already priced in. I just don't feel that comfortable myself.
So, Tina, in the past week, we thought we might get an update on further assistance from the US administration. The White House was said to be considering sending the Patriot missile defense system. Tina, can you tell me what you think is holding that particular decision up?
I mean, I think that we shouldn't doubt that the United States remains committed to supporting Ukraine, but it is likely that cracks are appearing in the way to best support Ukraine. And that, to me, is where we come back to that idea: does Ukraine start to take matters into its own hands, and also the Baltic states and Poland getting frustrated? It is far too soon to say, and I don't think it's correct to say that Washington is easing off. But as we're at this critical juncture right now, and we have to get Ukraine through the winter, we're starting to see more arguments about the best way of doing that and the types of weapons that are needed, especially with Iran supporting Russia with drones.
Tina, when you say cracks are appearing, they've been appearing over the last 12 months in obvious places between Republicans and Democrats, much more so recently. Are they appearing in more concerning places? Europe's been on the same page for a long time throughout all of this over the last 9 months. Are you seeing bigger cracks in how best to approach this?
Not yet, and where I would emphasize that particularly is in public opinion. There was high expectations, I think particularly from outside of Europe, that the public paying higher heating and electricity bills would translate that into demand to reduce support for Ukraine. You just don't see it in the public opinion data. Now, what's happening is that people are very unhappy indeed with their leaders, and this is perhaps especially true in the UK, which isn't even especially dependent upon Russian gas, but our bills have gone up considerably. So the blame on the cost of living crisis is falling squarely on national leaders rather than the war in Ukraine. I think that public support is solid, but there will be a period of fatigue, and that's what Zelensky and Ukrainian leaders are most concerned about. They can't afford to ease off in the next few months as fighting may become more sporadic, but again, the population is going to feel
Right.
the consequences in an absolutely brutal way.
Tina, to finish on yield curve control and the Japanese experiment, maybe Kuroda affected this experiment because of massive doubt over the animal spirit, the nominal GDP of Japan. John Farrow has brought up often here the question of the nominal GDP of Europe. Does Christine Lagarde, and for that matter, Governor Bailey, do they have the nominal GDP to affect a rapidly restrictive monetary policy?
It doesn't feel that way to me. It really doesn't. And there is a, again, I don't make interest rate forecasts as part of my official work, but from where we are in Europe, we know that we are at the most risk of recession. We know that we're experiencing a cost of living crisis. Central banks remain the most important actor, much more than national leaders. Your question about really whether they have the space, I don't think they do. I think that markets are still engaging in a bit of magical thinking when it comes to a pivot or a change. They need to tamp down inflation. And to me, they're going to focus on that at least for the next couple of months.
Hey, Tina, wonderful to catch up. Tina Fordham there at Fordham Global Foresight. Let's stay on the Japan story. Dollar yen right now, 132. Wells Fargo macro strategy just published.
What'd they say?
125 dollar yen's the call now.
Yeah.
They ranged this on the government bond market, and this is a really important question for Kelsey Barrow of JP Morgan when she catches up with us in about 5 minutes. They say Japanese demand for US treasuries and other foreign bonds should deteriorate further. That's going to be an interesting element. Maybe just taking the floor away a little bit more from treasuries and perhaps lifting yields just a little bit. And we'll see how that plays out over the next 12 months.
Yeah, that's some of the dynamics. And again, there's the core dynamic of Tokyo and what's going on there, and then these peripheral knock-on effects, if you will. What I see there is a move. Where were we? 150 and now 133 and going to 125. How often? When do we start hearing about 110 again? The answer's soon.
Maybe, yeah. Kelsey Barrow of JP Morgan up next. Bramo takes a day off and then Kuroda makes a move.
Well, yeah. Well,
look at that.
Her gloom poll was something. I mean, it was 49.9%. Focus on the Bramo camp.
Most fascinating entrepreneurs, because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, and the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The market is convinced and won't be dissuaded, I don't think in a hurry, from the idea that the economy is slowing.
Most other economies are either slowing or entering into recession.
As you get into 23, peak inflation becomes your number 2 concern, and you get into a growth discussion.
I think the economy will continue to grow through the first quarter.
The floor has been set, and the worst is certainly behind us.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Governor Kuroda, we needed something to talk about, and you delivered. Live from New York City this morning. Good morning for our audience worldwide. Alongside Tom Keene, I'm Jonathan Farrow. This is Bloomberg Surveillance with dollar yen at 132. TK, that's a monster move. Dollar yen, negative 3%. A stronger Japanese yen and yields higher, much higher.
Monster move, and houses publishing this morning, folks. This all occurred, what, John? 1 a.m., I'll say, our time, and we're just starting to see written words. Thank you, Citigroup, for really being out front on that, and Fujika in Tokyo. And John, it's real simple here. Clearly, the trend is we are now in play back to some form of strong yen. Kit Jukes, we're at a 1973 value of weak yen.
We've got a new range and a new ceiling, 0.50, 50 basis points. And right now, Tom, we're at 15. On a session in Japan, we closed at about 40 basis points on a Japanese 10-year. So, TK, the question I've been asking, I'll keep asking it, and we're going to have to ask our guests this question as well. Do you believe this is the step towards normalization, or is this resetting policy on a more sustainable path as Governor Kuroda exits in April? Overwhelmingly, the response so far has been the former and not the latter. There are people lining up to suggest that we get a rate hike from this central bank next year. 12 months ago, that was unthinkable.
To me, it was a surprise. That's the first order of any central bank. That's a reading a history of Meltzer, Bernanke, Anna Schwartz, and the rest. But also what I would state here is maybe there's a bit of a hopium, as we see in other central banks, John, that inflation has topped out. In Japan, let's call it 3.7%, with their useless nominal GDP. That's a big number. That's like 8%, like 10% in other societies and cultures. And maybe there's that hope that they can get out front with this little tweak of inflation coming down. That may be the hope that we see at the Bank of Japan.
And this was the last anchor around the neck of the government bond market worldwide. JGBs. The bond market was the story for much of the last 10 years with the ECB. That's gone. The JGB market, let's see if that goes in the next 12 months. And then you've got a new call. How far do treasuries go from here? How much higher do yields go with this move from the BOJ?
Well, that's going to be the speculation in today, but I think on first principles, what we need to say is everyone's dealing with some form of transparent argument and dynamic. Bank of England, John, which you're expert on, may be different than what we see at the Fed. I think after the last Fed press conference, neither of us are expert on whatever was said at that. I'm still not sure what was said. McKee will answer. But there's a fiction in Tokyo. And what's important, folks, waking up to this fancy PhD dynamics, is the fiction is maybe beginning to end. And the fiction, the point of this, folks, is buying in bonds, where John Citigroup publishes this morning, some of those tranches aren't, they own 50%, they own 80% plus.
Well, to use your phrase, the artificiality of this market.
It's complete
It's not a market, it hasn't been for a long time.
Anywhere.
Hasn't been, but Tom, they're going to keep buying. They're going to keep buying, they're going to keep buying, they're going to keep buying. I'm not sure that changes overnight.
Yeah, well, this is important, and do the math. It's 7.2 up to 9 gazillion trillion yen, whatever the zeros are after. It's a 20% lift. So to borrow from foreign exchange, the word we use is sterilized, where they're saying, okay, here's our action, but the but is they're going to continue buying the bonds up 25%.
Dramatic move, yes. No drama in this market. Look at futures right now. Equity futures on the S&P.
The VIX 22,
unchanged.
the Dow Jones Industrial Average unchanged.
Unchanged in the equity
it's just
market.
amazing.
We've got a yield move, but that could be a move on any other day for the rest of this year. The 10-year up by 6 basis points at 364.35.
Japan is so artificial. We don't have a Bloomberg Financial Conditions Index for Japan. We have one for Europe. We have one, I think,
Well,
Asia
max loose,
Japan.
max easy. That's been a story for like a long time.
But Japan, we can't do the math because the math doesn't exist.
We've got a fantastic guest around the table with us this morning. Happy to say that Kelsey Barrow of JP Morgan Asset Management joins us, fixed income portfolio manager. Kelsey, can I go to that question? I think the go-to question of the morning. Is it a step towards so-called normalization or just resetting the policy stance for something more sustainable? Which one is it?
So we did feel that the Bank of Japan's policy was unsustainable. It was time for a move by them. We think that it was important that they did it now. They could have waited till January, but they didn't. And so what we see is a policy rate or a 10-year yield around 50 basis points is actually fairly consistent with the 10-year yield that we have right now. So we don't necessarily think that this is a huge story for the Treasury market. Where we are expecting to see a lot of flows is in Europe. So we do expect European bonds to sell off on this. That's where you're going to get that repatriation trade from the carry trade.
So this is the Japanese demand that you think is going to wane, the Japanese demand that was going into European bond markets. Is that a problem for bonds, a problem for the Italian bond market? Where's it the bigger problem?
Well, I think in general, we've seen upward pressure on yields across Europe. And I think it's really interesting that you had the Fed try to be as hawkish as it possibly could last week, and they weren't able to tighten financial conditions. And finally, you had the ECB and the BOJ come to the rescue and get financial conditions to tighten. The Fed is not going at it alone. I think that is actually a positive for bond investors next year because global inflation is going to come down, and we're seeing these yield rises as an opportunity to buy bonds and to leg into long duration positions.
You have the great fortune of sitting across a desk from a guy who I think saw the financing of World War I, Bob Michael. I mean, it's amazing what you're dealing with.
That was both a compliment and an insult, wasn't it?
It was, yeah, we're working on that.
I'm sure
Good
Bob's
morning,
going to
Bob.
love that.
Yeah, thank you. The bottom line is everybody watching and listening has seen a minus 13% Bloomberg total return. It is now negative 6% annualized, 2 years now, 6% down, 6% down. How long does it take for me to get back to even if I'm running an adult bond portfolio? Do you and Bob look at it as a 2-year exercise, or dare I say, is it a 5-year exercise?
Right. So I think the question you're asking is very important because we talk a lot about what's going to happen in the next 1 week, 2 week, 3 months. But when you look at a, let's just say, 12-month horizon and what you could potentially get from a bond portfolio over the next 12 months, let's just look at the global aggregate, for example. The yield is around 5% on a US dollar hedge basis. And if you have, let's just say, a modest 50 to 75 basis point rally in yields over the course of the next year, you're getting high single-digit returns on that portfolio next year. So that is why, kind of across the board, you're hearing people say, not just bonds are back, but as we like to say, fixed income's fashionable again.
Fixed income's fashionable, Tom. What do you make of that? I'm hearing the equity guys talk up fixed income a lot.
I'll go with that. You see it behaviorally and culturally, folks, when you're walking down the street in New York. That's like 18 months to get my portfolio back to zero is what I'm looking at. Where do you do that across a continuum? Do you use full faith and credit? Is it IG value? Or do you have to go to the land of Bramo and distressed?
We are sticking with high quality. That has
Could you see the TV show Bramo Barrow?
No.
It would be just.
That was the oil call of Lisa back in the day.
Yeah, but Bramo Barrow would be a great 1 hour fixed income distressed debt. It'd be a great show.
Okay.
It'd be good. Excuse me, I interrupted.
Yeah.
Continue.
No, absolutely.
No, Cassie,
I'm
you
on
just
board.
let him carry on. Yeah, great.
Just continue.
Ignore it.
So we are focusing on high quality. When we look across the opportunity set with risk-free rates significantly higher, you don't have to extend into those sectors to get the yield that you want to.
Right.
So we're thinking about agency mortgages. We're thinking about investment-grade credit.
Right.
We're thinking about securitized credit that's higher up in the capital structure.
Okay, I haven't asked this question, I think, in like 17 years. What does issuance do? What does IG quality do? All the CFOs were down at wicked low yields. They're loving it. how do they reset, and will J.P. Morgan see issuance in the next 12 months?
So they are going to have to continue to issue, but generally, banks have banks as well as the rest of the IG universe have termed out their balance sheets, and they've made themselves put themselves in a very good position.
Exactly.
High cash balances. They've extended out that debt, and they've put themselves in a position where going into an expected recession, we've never seen corporate fundamentals to be better.
Can I finish on the high yield call then? Because when I last spoke to Bob, he thinks we're going to get some real spread widening in a recession on high yield. Can we finish there? What are your thoughts on that now?
We are still expecting that spreads are going to continue to widen here. So if you look at 400 basis points range on high yield spreads, what we're thinking here is, yeah, if we do get a soft landing, these spreads are reasonable. But our expectation is that with the most aggressive central bank tightening that you have seen since the 1980s, eventually this is going to bite. And inevitably, when the recession comes, spreads are going to widen further from here.
This was great. Kelsey, come on more often. This is just fantastic. Love Kelsey Barrow from JP Morgan. Have you ever watched Titanic?
Of course.
Of course. Okay. Gladiator.
Sure.
Have you seriously never watched Gladiator? Okay, you've got company. Trading Places.
Yes.
You've watched Trading Places. All right. What else haven't you watched? Rocky.
Rocky I've never seen.
Never seen Rocky.
We have to do a viewing party together for
Top Gun?
these. Yeah.
Top Gun.
Yes.
I'm giving you my Paramount login. How have you never watched Top Gun?
John, both of us go home, and Bob knows this too. He lived it. You're watching Rocky. We're reading Fobosi. That's the difference.
I guarantee that Bob Michaels watched those movies.
Should we do a junket to Tokyo? Me, John, and Bremo? I think team coverage from Tokyo in the evening would be great.
With the new central bank governor?
Well, yeah.
You want to do surveillance from Japan?
$13,158 round trip.
So you don't have to wake up as early. We do Bloomberg surveillance in the evenings.
I've done it many times, actually. Coverage from Tokyo. I had some really emotional things around Hiroshima with that. And it's just a beautiful city to do from. You go in the evening. You do the broadcast 6 p.m.
Okay.
In the evening, big view of the square. You can't show the Imperial Gardens. They don't let you do that from our Bloomberg headquarters.
What's your favorite bar?
And one's serving me. I like to go to the Four Seasons downtown because then the chef was from Boston, so you get New England clam chowder you die for.
Is that actually true?
Yeah.
Okay.
Yeah.
All right, I'll check it out. Well, maybe we'll check it out.
It's good. I think a road trip to provide team coverage on Bank of Japan.
Kelsey thinks treasuries are a buy. That was the headline from that conversation, by the way. A buy at 360-ish. Kelsey, this was great. Thank you. I'm not sure you thought it was great, but it was great for us, so we appreciate it.
No, I learned a lot. That was good.
From New York City this morning. Good morning. Where's Lisa? We need Bramo back. Futures unchanged on the S&P. Yields up by 6 basis points on a 10-year. 364.17 from New York City. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. It's now up to the Justice Department to decide whether to prosecute Donald Trump for his role in the January 6th assault on the Capitol. A House committee voted unanimously to refer the former president for prosecution on 4 criminal offenses, including insurrection. In a radio interview, he called the January 6th committee a kangaroo court. A surprise move by the Bank of Japan. Governor Haruhiko Kuroda shocked markets by doubling a cap on 10-year yields. That sent the yen higher against the dollar. Many economists see the move as laying the groundwork for exiting a decade of extraordinary stimulus policy. Sam Bankman-Fried's preparations to be extradited to the U.S. appear to be back on track. The FTX co-founder told the judge in the Bahamas he'll end his fight to avoid being sent to the U.S. to face criminal charges for the collapse of his crypto empire. But his local lawyer said he wasn't aware of the plan. The hearing was adjourned and Bankman-Fried returned to jail. Now it appears that he and his lawyer are both on the same page. Ukraine has reached a deal with Elon Musk's SpaceX to receive thousands more Starlink antennas. They'll be used to counter Russian air attacks. More than 10,000 of the antennas will be sent to Ukraine in the coming months. They provide internet service beamed down from satellites. In the UK, more labor problems for the National Health Service. Nurses are on strike today after their first walkout last week. The Royal College of Nursing says it has a mandate from members to continue action for 6 months unless their wages are raised. Meanwhile, ambulance workers are set to strike on Wednesday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. The top names at the Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
The committee has evidence that ex-President Trump planned to declare victory and unlawfully to call for the vote counting to stop, and that he told numerous allies about his intent in the weeks before the election. The committee found that Mr. Trump raised hundreds of millions of dollars with false representations made to his online donors.
That was Representative Zoe Lofgren of California there. We'll pick up on that story in just a moment. Live from New York City. Here's the price action for you. Off the back of a BOJ surprise, equity futures are just about unchanged on the S&P. Yields in Japan are a whole lot higher as the Bank of Japan shifts its yield curve control, a new cap on a Japanese 10-year of about 0.5, 50 basis points right now, 40 basis points, so 10 basis points south of that cap. Yields rising on treasuries up by 6 basis points on a 10-year, 364.54 on a 10-year. Euro dollar not doing much, 106.37. A stronger euro, weaker dollar. The dollar a whole lot weaker against the Japanese yen. Dollar yen seeing a move of more than 3% in the yen's favor, 132.59. That's the cross-asset check. I wanted to pick up on Apple briefly. As many of you know, I'm sure, following this market, this stock has had a difficult month of December. On the month so far, down by more than 10%. This morning, down by about 0.2%. In the last 24 hours, JP Morgan cutting his price target again, lowering the price target to 190, cutting, Tom, Christmas iPhone expectations once more, a partial demand recapture in fiscal second quarter 23. So is it revenue lost or revenue delayed when it comes to the iPhone?
It's a jumble. There's all sorts of different opinions, but my parsing of this, and unfortunately I've got 7 new iPhones at the house, so I'm biased on this. It's everybody wants the same damn phone, and the other phones I could care less about. And so there's a product differentiation here, and I believe it's international, and it's making it. This is what Cook does best. I mean, this is basically where he came from, is getting the stuff made, getting it out the door. Everybody wants the same phone this Christmas.
You've basically answered the question, haven't you? That if you can't get the phone this quarter, you're just going to buy it in the following quarter?
I guess so. Yeah, that's been the history of this. Joanne Wittenstein has a great summary on Apple, the use of cash, and these challenges, John, in Bloomberg Business Week this week. It's really quite a good, complete article.
Another way of asking this is, do you think we have a supply problem or a demand problem? And you're saying it's the former, not the latter.
I'm saying the Apple Gloom crew has been wrong
repeatedly
forever.
Sure.
At some point, they're going to be right. Is this the time? I'm not willing to go there. But I would say they have to be affected on both sides of the microeconomics, supply and demand, more than any other company I can imagine by China.
Do you know where
there's just a major focus.
The analyst community is right now. The A&R function on the Bloomberg, just looking at Apple at the moment.
Please.
37 buys, 7 holds, 2 sells. Still overwhelmingly bullish in the analyst community on this name.
Yeah, well, and
as
as Joanne says, they've done better than other big tech companies, particularly Amazon, always a compare and contrast there. And they've outperformed them, and maybe it's use of cash and share buyback and such, but there it is.
12-month average price target, 173.
It is.
Some upside there.
Yeah, I got the new phone. The camera's an act of God. It's just absolutely fantastic.
Okay, they caught it with Samsung on the camera.
Pretty much. I'm not like
Samsung
Mr.
was
Tech
pretty out
guy,
there.
but all I know is you hit the resolution button and it's like, oh, I did a shot of the squirrel in the Christmas tree. Anne-Marie wanted to see it.
I saw that out on Twitter.
Yeah, that's with 48 megapixel. Anne-Marie insisted I go to 48 megapixels.
So you've watched that movie?
Which one?
Chevy Chase, Christmas Vacation.
Oh, yeah. Many times. Yeah,
that's a good one.
Anne-Marie Horton joining us now from Washington as we migrate to Christmas. Yes, we have more on the Bank of Japan and the shocking news there. Anne-Marie, I want to go to what John is living. He's leaving early for England because of strikes. And yet here we are in America with nurses on strike. They're in strike in England, and there's some real strike challenges. Tell me about the president's approach to labor, to nurses, to strikes.
Well, I think we had that really on display over the course of the past few months, haven't we? The president really wanted to make sure he hammered out this deal. He wants to be the most pro-labor president in history, and he really makes that point across when he brings individuals from the labor unions to a number of press conferences. He was able to strike this deal on the railroads, but not all of the unions signed up for it. And then basically the White House and Congress forced them to accept this deal. So that meant that these individuals could not strike. Right. And at the heart of it was access to health care. And the president would say that he's been working for that, not just for union leaders, but for all Americans writ large. But it is interesting because as opposed to the UK, where I did live at one point, having strikes for, say, the metro, the tube, it's not exactly uncommon. But it would be incredibly uncommon in the United States.
Well, I'm asking you, as the most transatlantic of people in Washington here, and the Washington Post leads with the United Kingdom nurses strike. Do you have an anticipation that kind of labor challenge will challenge this president?
Well, potentially we can see it right with the dock workers in Los Angeles. I know John has spoken to Secretary of Labor Marty Walsh a number of times about this, who says that he thinks in the end they will come to an agreement. There is a shift in the sense that employees feel like they have more power against their employers, and that could potentially mean you do see things like strikes. We have seen that over the course of the past few months when it comes to the railroads. We've seen it with Starbucks. Potentially, we could maybe see more of this. It's a good question.
Raises the question, Tom, just how much leverage you think Labour has in this labour market.
Well, that's the urge.
Whether that's waning going into 23. Are we chipping away at that? I'd argue on Wall Street, and this is a very, very narrow segment of the overall labour market, but on Wall Street, I would say that leverage has gone pretty quickly over the last 12 months. Just look at the news from Goldman last week.
I don't have a strong opinion on this. I feel very strongly the United Kingdom is a different labor environment than the United States. But the question to me, and Anne-Marie, this comes back to monetary policy and the risks that Chairman Powell faces. Do we anticipate with inflation coming in that wages come in as well? most people I know in most industries are screaming for help.
They are. They want higher wages because when you have 7% inflation, but wage growth not meeting that 7% inflation, you're basically taking a pay cut, right? What you're hearing in Congress, and it's interesting you bring this up because, of course, we just had about 1 a.m. today, more than 4,000 pages for their spending bill released, is how the Republicans and the Democrats are going to try to say they won this spending showdown. And for the Democrats, it's things like grants to child care up 30%, but they didn't get those extended child tax credits that they really feel helps working class families that are begging and saying they need more. They cannot afford to have a job and also make sure that their kids are getting childcare.
AMH, serious issues. Anne-Marie down in DC. Anne-Marie, thank you. Thank you very much. On a less serious issue, do you remember that story of that Goldman analyst that did that PowerPoint presentation to leadership about how tough that job was in investment banking?
Yes, junior banking.
Doesn't that feel like 10 years ago?
10 years
ago. Can you imagine that same presentation being made on Wall Street right now? Going into next year.
I'm glad, there's a lot of things, folks, that we talk about off camera and we don't talk about on radio, on TV as well. But I think we can say with hindsight, and no one will believe me, but you and I were sitting here with Brammo looking at the SPAC revolution, which kept equity going for months, going, really? Paul Sweeney, who's got knee-deep, tangible, real-world experience in this, was just stunned by it. And so we can't say on air, hey, this is a bunch of baloney. We're not allowed to say that. But in hindsight, we can say, well, the SPACs, that went away.
Well, I think one thing we committed to was never having that kind of program where a celebrity came on and started endorsing financial products. You know, when the celebrities started doing the rounds, pushing SPACs, I have huge problems with that.
Well, I have trouble. I mean, I've got a whole entourage that polices me on the triple leveraged all cash fund. I mean, I'm sorry, 2 and 20 that's paying out this year.
Do you know what's not paid out this year? 60-40. So going into next year,
this is my third rail.
We can reset now. Going into next year, 60-40, good setup. Based on where bonds have repriced to, I think the fixed income.
Gotta love it.
Fixed income guys would say the 40's looking good going into 2023.
I'm hearing that. Yeah, or even 60-30-10. But I just think a lot of them are muddling along. It'll be interesting to see what people do.
On the equity side, just a push for active, Tom. You hear it again and again.
Again and again and again.
Futures unchanged on the S&P. From New York, this is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Trying to snap a 4-day losing streak on the S&P 500. Equity futures totally unchanged on the S&P, unchanged even after a big shift from the BOJ. The Bank of Japan shifting their yield curve control, lifting the cap on the potential for 10-year yields to go higher in Japan. That makes a move in the Treasury market possible as well. Yields on a 10-year right now look like this, up by 6 basis points to 364.91. On a Japanese 10-year, up a whole lot more today. We look a little something like this on a JGB, a Japanese 10-year shaping up as follows. Yields higher by 15 basis points to 0.4%. Great coverage by the team here at Bloomberg, and fantastic of them to catch up with two individuals that were short this market. Two firms that were short JGBs are staying short. Here's a quote from Kelly Wooders-Schroders, who said the following: "The market will now pressure the BOJ. We are adding to our short position and building our position in yen. This has more legs. We're on it." Russell Matthews at Blue Bay Asset Management echoing the same thing, saying, quote, "Although it's a small shift in the band, the genie is out of the bottle. We will stick with our short JGB positions for the moment." So, Tom, I go back to the question of the morning that we've been asking. Do you believe this is a step towards normalization, one, or do you believe this is about resetting policy on a more sustainable path? I think a lot of people that came into this looking for the shift from the BOJ, they got the shift this morning. They believe there's more to come. They think this is a step
What are the
towards
constraints? What are the
normalization.
constraints that Mr. Kuroda in the follow-on in April? What are the constraints that they have?
That the market testimony goes too quickly and they don't control the move. They want to control that shift towards normalization. They want to control it and the market won't let them.
That's
the difference. And that's the risk. I'm not saying that's going to happen. That's for someone else to make the call, but that's the risk.
Our team has been working since 1 a.m. on this in London, in New York, and we are thrilled for Global Wall Street now to bring you Dominic Constam. He's head of macro strategy at the Japanese bank Mizuho. He is at Mizuho Americas. I want to make clear that he is not speaking for the management of Mizuho Bank. That would be inappropriate. For those of you in the United States, Mizuho is a 1999 roll-up of 3 banking giants in Japan. Mizuho translate as golden ears of rice, and all ears at Mizuho Tokyo are attuned to the monetary policy of their Japan. Dr. Constam, thank you so much for being with us today. Dominique, it's just as simple as this. Given the zombie nature of the Japanese economy for 20 years, the dearth of nominal GDP, the bouts of disinflation and outright deflation, how constrained is this Bank of Japan forward? How many degrees of freedom have they lost in the lost decade?
Well, I mean, they are clearly constrained in terms of the idea that they're going to sort of normalize policy in any way that we've seen it elsewhere. But I think the time, clearly, the idea of the targeting the 10-year yield and having negative interest rates, those days are numbered. The market's now pricing for positive interest rates next year, and this is basically letting the genie out of the bottle. And I think it's something that we all expected, but the timing was obviously unexpected. I mean, the BOJ could have done this earlier in the year when the yen was under a lot of pressure. That was the obvious time to do it. I mean, we were pricing for positive rate hikes sort of positive rates, I should say, at the front end back in June of this year. So the idea is that they brought this forward. They're doing it before Corona is obviously stepping down. I guess there are certain reasons why they're bringing it forward related to the fact that perhaps they see an opportunity to do it now, better to do that before the Fed is actually reversing course on their own rates, a path perhaps as priced by the market.
Right.
So I think that's a logic behind some of this decision to go earlier.
If there is a bet of disinflation, 2 bouts of U.S. inflation statistics better, even in the United Kingdom, a little bit of a whisper of better inflation. Is this a bet by the Bank of Japan that 3.7% nationwide CPI can come in?
I think that's very interesting. I mean, basically, we are seeing Japanese inflation rising now. Is going to be around 4%. The focus on the inflation from our Japanese colleagues has been really around the wage side to it. So the large wage negotiations start taking place really in spring next year. So some of the logic for delaying any move was to see kind of how those wage negotiations go, because the inflation you're seeing now in Japan is really very much imported from the weakness in the yen. And to the extent that that becomes self-fulfilling because, say, wages are allowed to rise, that's a big uncertainty. So my guess is one read from the decision to move earlier is there clearly is going to be an expectation now that you are going to see some wage growth, finally some decent wage growth, at least in line perhaps with inflation. Exactly.
Dr. Konstam, you have written must-read essays on quantitative easing and quantitative tightening. And then there's a government with 50 to 80% ownership of domestic bonds, a government looking at a fiction of a debt to GDP ratio out near 230, 250%. Do you have a confidence that Japan can unwind those two extreme positions?
Yeah, I mean, to be honest, we do. I mean, the reason is obviously if there was a shock widening in the band, or just getting rid of the band and allowing a sort of free fall in the market, then obviously that would have raised concerns, for the debt holdings of Japanese financial institutions and how well hedged they've been. I think over the course of this year, probably hedging has been actually put in place quite actively. We also know that, for example, in the foreign bond holdings, the Japanese institutions have been very cautious around the increase in interest rates globally. So I think the concern around sort of financial stability related to a sort of shock move in interest rates has diminished in recent months, and the fact that they are only moving 25 basis points. I mean, it's not it's not massive, and the back end has obviously moved a lot before anyway. So I think from that perspective, there's relatively more comfort from this unwind of quantitative easing. I think that the issue fundamentally, though, for Japanese financial institutions is they need to obviously get their sort of loan deposit ratios back in order and sort of reduce their reliance on JGB holdings as a large part of the asset side of their balance sheets, and that's going to take a long time. And I think I think normalizing interest rates at the front end in a sustainable way, because inflation is higher and nominal growth is basically more sustainably higher. That's going to be the way in which the Japanese banks will restructure their balance sheets going forward. It's going to take a while. We're not having a massive rise in interest rates. I think fair value in JGBs, according to our JGB strategist, is around 75 basis points in 10 years. So, you've basically done half of that move, basically, today, and no doubt we'll, get the other half in due course, but probably not until the BOJ has actually lifted the overnight rate as well.
Dom, there will be a lot of people waking up this morning thinking, well, what does this mean for me? Why should I care? Dom, what does this mean for global markets outside of Japan?
Well, I mean, that's really important, and we all had that thought. It's like, oh my God, sort of what does this actually mean for global bonds? The first thing that obviously occurs to a lot of people is that we've already sold off global bonds massively without the Japanese markets really being that involved. So the old days when Japan would move aggressively, it was often seen as a bit of a harbinger for a global bond sell-off, and that was all related to things like the yen repatriation trade. It was related to a lot Japanese holdings of foreign bonds that they basically needed to bring back because they were less attractive. There were hedging costs that kind of undermined their attractiveness, etc. And so that was always a concern. What we've seen seen really this year is the marginal flows out of Japan have obviously been zero, actually negative. They've been net sellers of global bonds, quite impressively so. That's partly because as the bond market has sold off globally with the ECB and the Fed raising rates and relatively aggressively, it's not attractive for them to be overseas. So my guess is that the impact basically is going to be much more muted now, and so far that's already been the case. And it's just that these guys have not been exposed as they might have been in previous cycles. So yes, it's a small negative for global bonds, but we shouldn't see a sort of a kind of collapse in bond markets higher, yields higher, on the back of this normalization. That would be my initial take.
Hey, Dom, are we going back 10 years when we used to look at that data for Japanese investors and where their money was going, how many bonds they'd bought abroad? Are we looking at that every month again?
There are important things to also consider. I mean, the attractiveness of the JGB market relative to treasuries on a hedge basis is still quite impressive. So I think basically the Japanese investors are being encouraged to sort of stay at home, relatively speaking, which is one of the reasons why you could argue the BOJ can have a fairly orderly exit at this stage, because JGBs are attractive and now even more attractive. So I mean, I think we can definitely sort of look at that data, but in the back. But I don't think it's the same. We're in a slightly different world now, partly because of the different speed with which these central banks have been moving.
Oh, without a doubt. Dominic, this was awesome. Thanks for being with us today. Dominic Constant there of Mizuho. Just a wonderful lineup.
Wonderful.
And I think we've now got some serious echo over the last couple of hours of people just saying, Genie's out of the bottom.
Yeah.
Genie's out of the bottom.
Heard that from
Keep
Dr.
hearing the same
Constant.
thing. Win thin.
Ian, I got goosebumps, folks, over how our team is killing themselves. Well, we got 30 people on this morning, I think.
Have we?
I mean, it's just maybe we brought in people. Yeah, I think it's 30. Maybe it's 28 people. I can't remember. But what I do know is Ian Lingon's coming up. He just took Institutional Investor Trophy in fixed income. Ira Jersey publishes moments ago. He thinks it will be a temporary effect on U.S. paper.
Well, Dom said it. Think about the move we've had year to date. I went through the numbers a little bit earlier, and if you're just tuning in, I'm happy to share them again. The US 10-year this year, up 215 basis points. German 10-year, 245. UK 10-year in the gilt market, 260. Same period, excluding today in the JGB market, Japanese 10-year up a single basis point. So the analogy you'll hear is it's like keeping a beach ball under the water. It's something Alarian would say.
That's good.
You keep the beach ball under the water and then you let it go, and what happens? Pop to the surface. And we've already seen the move in global markets.
Yeah, he's doing that because Cambridge Water Polo's like, trophy taken.
He joined us in about an hour.
Well, I'm not surprised. He's not joining on this property.
Looking forward to that.
The Jets lost. He won't come on. But, the bottom line, John.
That's why he won't come on.
Yeah, the Jets, they lost.
You keep bringing up the Jets.
I do. It's true. I look, John, at where we are and what Dr. Constant said there in terms of market people is we made half the move out to the Mizuho calculation of 0.75. That was great. To get him on from Mizuho Bank is what this show's about.
Laura Rain coming up of FS Investments. Equities, given all this drama in Japan, equities are down not even 0.1% on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After a 17-month investigation, a House committee has recommended Donald Trump be prosecuted for his role in the January 6th assault on the U.S. Capitol. It's now up to the Justice Department to decide whether to hold legal proceedings against the former president on 4 criminal offenses, including insurrection. Another House committee is scheduled to meet today to consider publicly releasing 6 years of Trump's tax returns. Negotiators in Congress have agreed to a $1.7 trillion spending bill. Now they'll try to send it through to the House and Senate to avert a government shutdown on Christmas Eve. The bill provides funding for government agencies through next September. It also includes more than $45 billion in aid to Ukraine. China is adding weight to the speculation that it's hiding the true picture of how many people have died since the end of the COVID-0 policy. Health officials confirmed that they have narrowed how they define a death caused by COVID. Only those people who tested positive and died of respiratory failure will be considered a virus death. Amazon has agreed to settle European Union antitrust investigations. Regulators accepted the company's promise to stop using non-public data on independent sellers on its marketplace for its competing retail business. Now, the agreement also includes offering equal access to Amazon's Buy Box and Prime services. And 3M will stop making so-called forever chemicals and quit using them in products by the end of 2025. The company faces lawsuits that threaten billions in damages. The class of chemicals is called by the acronym PFAS. They've also used in products ranging from smartphones to raincoats, are almost impossible to get rid of, and are blamed for a wide range of health problems. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Bottom line, it's clear that the Bank of Japan is going to hike next year. We had second half of next year penciled in. We thought, again, like consensus, new governor comes in April, he does a review, second half, rate hike. But I think that's moved timetable much further ahead. I think we get something as soon as Q2, once a new guy is, maybe even Q1 if Kuroda wants to surprise again.
Maybe even Q1 for rate hikes from the BOJ. That was Win Thin, Global Head of Currency Strategy at Brown Brothers Harriman. And who are we to say that won't happen, given what has happened in the last 12 months with the Federal Reserve and the ECB, when 12 months ago, hardly anybody saw that coming. This from David Rosenberg out on Twitter. Here's a great line for you. While the bond vigilantes barked, the BOJ blinked. The BOJ last pulled a surprise like this on Christmas Day, 1989. We had a level shift in global bond yields, and the next thing you know, bond yields sank under the weight of recession for the next 4 years. Rosenberg just fantastic on the history of all of this, Tom. Just brilliant out on Twitter moments ago.
As everyone knows, John and I aren't in speaking terms. That's well understood. We don't even exchange Christmas gifts. And the reality here is you just gave me a gift because I missed the Rosenberg comment. This is the guy who parses inflation dynamics like no one. He was acclaimed at Merrill for this. And this goes to what we were talking to Dr. Constam about, which is, are they getting out front of a presumed disinflation, moderate or rapid, off 3.7%. That's the land of Rosenberg.
I don't know, but their policy this year stuck out like a sore thumb. All the other major central banks hiking interest rates aggressively, and they were trying to stand still and keep their hand on top of government bond yields.
Yeah, well, there's no question about it. We got to do some business here. First of all, Alarian on when? 9 o'clock?
9 a.m.
9 a.m. is
in the studio.
In studio.
In studio.
Oh, he won't even deign to drop by radio and wave.
Going to guest host for 60 minutes.
He's going
to catch up with a range of guests. including Jack Caffrey at JP Morgan and Mike Schumacher at Wells Fargo.
Wonderful.
Yeah,
Wonderful.
Sarah Hunt in the mix as well from Alpine Woods. So, going to have a nice conversation.
Al Arian noting that he's not on this show because the Jets lost, and therefore, that's how you talk. When you're in Cambridge, you say, Queen's College.
The Jets lost, and therefore.
Therefore.
He's coming on at 9 a.m. and not.
She's on with us with a lot of experience. We get lucky. Laura Rahm was booked here, chief U.S. economist at FS Investments. But on this day of stunning international and monetary economics, she's hugely qualified on the dynamics at play. Laura, when you heard that news out of the Bank of Japan, you're responsible for synthesizing that for Americans. What is the ramification to American investors this morning?
Well, it definitely reinforces the trend of the weaker dollar that had already emerged over the last several months. The dollar and the strong dollar run-up had been a hugely defining feature. It's been really putting a damper on U.S. equities. It's been helping on the inflation side. But I think, when asked about the dollar for much of this year, my answer was, the dollar's strong, but don't blame the dollar. There's sort of really nowhere else to go with the geopolitics in Europe, with Japan really stuck at this zero, at the zero lower bound for policy and then pulling more accommodative. So I think this really helps to reinforce this broadly dollar weaker trend. And, especially you're seeing it in the entire Asian complex, which, now has the good news from China exiting zero COVID. I don't think it's emerged as good news yet, really, on the economic side, but it will eventually. So I think, to me, that's the biggest innovation that's happened after today.
To bring it back to your remit at FS Investments, how discrete and separate is the United States economy right now with the institutional policies we've had, with buoyant nominal GDP, and dare I say, people like Michael Ferroli at JP Morgan suggesting a pretty good fourth quarter GDP. How unique is America into the holiday season?
America does continue to sort of be a leader in economic strength, and that's saying a lot because I think we are going to get a solid fourth quarter, but that's really coming off of a pretty stagnant year. And growth expectations for next year are not particularly vigorous. In fact, I still think the probability of recession is quite high. At the same time, U.S. policy is really just occurring against this wave of tighter policy around the globe. So in this unique moment, where the U.S. business cycle stands out as stronger, it just means that the Fed is having to push a lot harder on the brakes to get us to slow down. It's one of the reasons why we've seen the Fed be so much more aggressive than other central banks.
Neil Dutta, Renaissance Macro, just moments ago in an email said this. Lara, I want your response to this. He said, historically, whenever economists have put odds of a recession this high, we're usually already in one. One of the ways recessions happen is through an element of surprise. That factor is missing right now. Lara, what's your reaction to that?
I do hear what he's saying because I think to some degree, and Tom and I feel like have talked about this over several business cycles, it's a self-fulfilling prophecy. When everyone talks about the economy slowing down, that's when it happens. One thing that has been very missing is any sort of job loss. And this is something that I want to make crystal clear. When the job losses start to happen, that's the recession. Multiple quarters of payroll losses is the start of the recession. It's like the weatherman standing in the rain saying, I think it might rain. The job losses don't cause the recession. The job losses are the recession. And we just haven't seen them yet. My canary in the coal mine is initial claims. The canary still looks pretty healthy, but this is the uncertainty that's going to weigh on markets through much of the year. I think we were thinking we were going to have this really, nice rally into the end of the year, and that the legs are really being chipped away from that from a variety of directions. Today was just the latest.
Can we just sit on that number, claims? Was it 211 last week? We'll get more claims data.
Yeah, it's really hard for me to see cracks developing in the labor market.
What's behind that number? Because I've got people telling me, well, maybe these numbers just don't reflect what's actually happening in the labor market.
I mean, the claims do. If people can get unemployment benefits, they go and get them. At the end of the day, we have very little productivity growth. We're bringing back workers. They're not adding to extra output. It gives us this feeling of stagnation. But on the jobs numbers, we're still looking really positive. I just don't buy that cracks are forming yet.
How's the consumer doing, Laura? It's a conventional U.S. question into the season. How's the consumer doing? They look alive to me.
Yeah, it has to be the question, Tom, because, that's by far and away the biggest sector of our economy. And it's the jobs holding in, the consumer is going to hold in, for a variety of reasons. Income growth remains really solid. And I think, easing inflation really helps that. At the end of the day, high food and energy costs in and of themselves are going to dampen U.S. consumption. As that has come down, I think that combination, lower gas prices, really gives the consumer a boost. But, it's robust for a quarter. I think going into next year, I'm still expecting full year growth of only 0.3%. And I think, that turns negative at the end of next year.
Well, Lara, in line with Lisa Bravitz on the recession and the doom of 2023. Yeah. Everyone's on that page now. Lara Rame of FS Investments. The doubts, Tom, and Lara, thank you, around the Federal Reserve and the ECB. We all had the same argument. They couldn't get above 2, because if they got above 2%, there would be problems with debt. There's too much debt out there. They couldn't get above 3 for the same reason they couldn't go through 4.
Can't do 4.
And yet here we are.
Here we are, and it feels like the 70s where here we are, and you know what? We somehow survived with some real societal pain as well. Tony Dwyer absolutely nails it at Canaccord Genuity. Not that I've talked to him this year, but he talks about generationally levered system. And that's what we've got off a health disaster, a pandemic. Every nation's the same, but we forget what Japan's dealing with. Debt to GDP, this is just one metric, apples to apples. I've got a calculation for Japan of 237 plus, many people thinking that will drive higher. In the U.S. on the same equivalency, roughly 107%. That speaks of that tension, the reality Tokyo has.
Who's got the leverage? The households, the companies, and the sovereign. And you're talking about the sovereign here, right?
Yeah, I think I'm in the camp, it's a sovereign mess. And I think the reporting that I would hear from, say, Robert Feldman at Morgan Stanley, expert on Japan, is companies there are maybe in pretty good shape. I don't want to be an authority on that.
You hear the same argument here in the United States. These massive fiscal transfers to household balance sheets, which were much, much stronger, been chipping away at that all year. We'll see if that holds up through 2023. But that's basically been the argument on the corporate side as well, that we just haven't had that explosion in leverage. We haven't had a long enough expansion to build up that leverage. It's why we keep hearing this argument that we'll get this recession, and it will be shallow. It will be shallow. It will not be deep.
I was looking at, doing a road trip to Hotel Chelsea today to celebrate how hard our team has worked today. But Chelsea says they can't take 28 people.
Where's Hotel Chelsea?
It's downtown.
Never heard of it.
Down. Some of our hipster staff live down there. I have never been there. I've never been below 59th Street, but, I was thinking
58.
Once a year.
We get dropped off on 58th.
Well, no, I get dropped off in 59th.
And then you walk.
Kurt and I walk. It's a long walk.
You walk. Do you walk a block?
I walk a block.
Why do you do that?
Just to loosen up. When you're a fossil, you got to greet the morning in a certain way.
Okay. Do you actually walk a block?
I go 2 blocks, sometimes 3, depends on,
Or you just go round and round?
Yeah.
Do you have a cigar, or you just sort of like...
I have a cigar before I get to work.
You have a cigar before work?
It's like Churchill.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long and a persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And fundamentally, it's done through the equity markets.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
The U.S. probably started to enter into a recession at the close of the year.
The discussion now becomes how deep a recession, what is the impact on earnings, and what do we see during 4Q?
As you have a higher cost of debt, it starts to slow the economy.
The U.S. consumer has a fair amount of money saved up. Employment is very strong.
I don't expect a recession quite yet. I think the economy still has considerable forward momentum.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An historic day for Tokyo and Japan. The Bank of Japan simply blinks. We'll have much more coverage on that. Thrilled to bring you, as Dominic Constant before of Mizuho, Ian Lingen will join us from BMO Capital Markets. He just took the award an institutional investor for fixed income strategy of the year. And Mohammed El-Arian will join John in the 9 o'clock hour as well. I think El-Arian and Lingen are going to be on the same page. Does it matter to us directly, John? No, but it is a moment in this pandemic recovery.
Mohammed warned about this several times through the year. We've heard a couple of guests already this morning use the words genie out of the bottle. Genie out of the bottle, because I've been asking the question whether you think this is about a reset of policy, a more sustainable, dovish policy stance going into 23, or whether this is a step towards normalization. A lot of people this morning think it is a step towards normalization. Win Thin of Brown Brothers Harriman about a couple of hours ago, Tom, on this program. He thinks rate hike, potentially first quarter of 23 from the BOJ.
And I know this is not popular, but I'm going to say it, particularly after the transitory disaster, but Chairman Powell, in steadfastness, and frankly, Lagarde and Bailey as well, they have to take comfort that they're joined today by the Bank of Japan. Do they throw in the towel? That's not accurate, but they blink and move towards those three other banks.
They were certainly the outlier, that's for sure. And we need to reset now and think about 23. We came into 2022 12 months ago with a Fed projection of 90 basis points, tightening of 90 basis points through 2022. They ended up through 4. That was a big, big change that we did not expect. Going into 23, Tom, you ask yourself, where's the surprise going to come from this time around? What are we wrong about looking at 12 months?
I'm going to go to David Rosenberg and thank the guests that have come in, and thank you for the research notes of Wall Street coming in today, particularly Ira Jersey, Bloomberg Intelligence coming in 20 minutes ago. And John, I'm going to go to Rosenberg, which is the dynamics, the calculus of the inflation trend, and we can't predict that, and David knows that as well as anyone, but you have to wonder, it's 3.7% inflation in Japan. Well, is this a bet that will come in? Constant was, I think, constructive on that.
I don't know. One thing I do think, with Governor Kuroda, we've asked the question, Tom, why didn't they move with the ECB, with the Federal Reserve, with inflation picking up? They have a very, very different historical perspective on all of this. This inflation story is new to the Fed. It's new to the ECB. It's something the Fed hasn't had to deal with in 30, 40 years. For the BOJ, they've been trying to generate inflation for 20 plus. And this BOJ, I think, Tom, probably saw this as a once-in-a-generation opportunity to reset inflation expectations higher. What's become clear, though, with government bond yields up more than 200 basis points in the US, in Germany, in the UK, to keep things where they were in the JGB market has become unsustainable. And I think that's what they're trying to communicate this morning.
I've never bought the Kool-Aid on this argument as well. What I think really doesn't matter. Dr. Constam of Mizuho was heated that so much of the inflation in Japan is imputed or pushed into Japan by other events, other moments, including China. We can't forget China in this discussion as well. On data, John's noted all morning the quiet. John, I'm going to go to the VIX, 22.56, really unched off this remove from the drama in Tokyo.
We said it's a big deal. It's a big deal what's happening at the BOJ. And here we are down a third of 1%. Yeah. The S&P yields up by 7 or 8 basis points. Have to say, though, over the last couple of days, we've had a lift in a 10-year Treasury back to 366. And equities coming into today, Tom, into Tuesday, down for 4 straight sessions. We're down 5% over those 4 days. So it's been a soft patch, a softer patch for this
dollar yen, 132.79. Let's talk about that. 4 big figures in, and you mentioned a major American bank, I believe, with a 125 Vista from a stronger yen, 132 to 125.
On the macro strategy side, Wells Fargo, dollar yen, back to 125. I'll catch up with Mike Schumacher in about 60 minutes or so. He's got some amazing calls, you know, for next year, Mike Schumacher.
Well, they all do. And I mean, it's exciting, and we're trying to keep a score of them. And of course, everything adjusts today with this blockbuster out of Bank of Japan. Megan Horniman joins us now, Chief Investment Officer, Verdant's Capital Advisors. Thrilled she could be with us to synthesize this for American investors. Does this give a further confidence, Megan, that I can invest in fixed income for total return next year?
No, I still think from an investment standpoint that this is going to show you that interest rates, especially even on the long end of the curve, have more room to go. We're seeing that this morning. What Japan has done is really just jumped on the wagon with the rest of the world. It's the end of an era, and investors have to get used to higher interest rates across the curve.
Megan, I spoke to Tom just moments ago and said Mike Schumacher would join us, and he's got some amazing calls. Let me share some of them with you. On nominal yields, the 2-year, he sees it getting back to the high 4s, the 10-year back to about 4.25. Fed funds, he thinks, is going to go through 5% and stay there through most of next year. Megan, are you on the same page as that?
Yes, I am. Our Fed funds forecast is about from a 5.25 to a 5.50, and to stay there. And I think that's the disconnect in the market right now. If you look at the futures market, they're expecting rate cuts pretty quickly in 2023. That's not our call. Once the Fed gets to that level and inflation gradually comes down, then they can say they may be in a restrictive territory. But right now, we're still not restrictive. I think the long end of the curve, I would say maybe 4.5 to 5 also. And then the shorter term as well, going up that to about that 4.75, 5%.
Megan, just to be clear here then, you don't think we get rate cuts through next year. Is it because you disagree with the forecast, the consensus forecast for next year, or because you disagree with the interpretation of the Fed's reaction function? Which one is it?
I think that they're not going to have enough proof to say that inflation is truly behind us to be able to cut. I do think that the economic environment is going to be very weak next year, but I don't think that the Fed is going to be able to say that they've completely put inflation behind and give them that flexibility to cut. They can stop, and the market will take that in a favorable view, but I don't think that they have the room to actually cut. I think that's more of a 2024 story.
Megan, if we get price down and yield up and whatever the first and second derivatives are of that action, what does it do? How does it redound upon the American economy?
Unfortunately, just from the economic standpoint, housing is going to remain weak. Consumers are going to really start to feel the pinch of the higher interest rates next year. I think you've seen a lot of resiliency in the consumer, but when you start to see credit card rates where they are, auto loan rates where they are, this is going to cause a significant slowdown in spending on the consumer side and possibly even on the business side. So I think you'll get that pullback from the economic standpoint in the first half of next year.
You know, I look at the, you mentioned the credit card numbers and I guess it comes down to just retail spending and that. I mean, link in your bond call into what it means for the tangible consumer, because a lot of people are telling us solid, stable, buoyant consumer. You're pushing against that, aren't you?
Mm-hmm. Yeah, I think if you look at the consumer spending, how are they spending? They're using credit card debt, and we're seeing that grow on a double-digit pace over a year-over-year basis. That is not sustainable in an environment where you're also seeing those credit card rates increase. It can't be sustainable into next year. I think when just the consumer, if you look at confidence as well, that's also been a big disconnect. Consumer confidence has been very weak for very long, typically has some correlation with spending, and we haven't seen that yet.
So, Megan, you think inflation could be sticky, that the mission won't be completed next year for the Fed fund stays elevated, growth gets a little bit softer. I know where you are on Treasury yields higher. Where are you on risk assets?
So I think right now going into 2023, it doesn't hurt to actually maybe get a little cash back into the portfolio, maybe reduce overall risk in the portfolio from the risk asset side from equities, but have that dry powder ready to go, because when that Fed does suggest that they're done, and I do think that they're going to be able to suggest that they're done in the first half of next year, not saying they're going to be able to cut rates, but they can say they can stop where they are. That's going to lead up to what could be a really nice rally in the second half of next year.
You're not alone on that one, Tom, the first half, second half split that I keep hearing about. Megan, thank you. Megan Horniman there, Verdance Capital Advisors. This goes back to that sufficiently restrictive question of the last week or so. You heard it from the ECB President Christine Lagarde, the Fed Chair Jay Powell. What do you think sufficiently restrictive is?
I have no idea.
How far away from it
know what
are we?
transitory was.
How do they know?
We are I'm going to say the financial media is at fault here.
Why's that?
We're visible. We're out there. Everybody's watching. We know that. Thank you for watching and listening every day. But you know what, John? It's about we're over analyzing, gaming the short term. And I have too much respect for what I don't know to game out where inflation is January 12th or February, whatever it is. I haven't looked at the date yet.
You know the lesson of the last 2 years. Military. You get embarrassed every time you make a forecast.
Yeah, you do. And we take great respect. I mean, Ian Lingon's going to be on here, trophy taking for institutional investor, his value every day to his clients at BMO Capital Markets. But I'm sorry, John, even for a guy as smart as Lingon, this is brutal guessing.
Bank of America have got a nice note out.
Please.
Tom. It's how to talk to your family about the economy over the holidays. It's a list of questions. They give you the short answer and the long answer. They say, are we in a recession? Didn't we have 2 consecutive quarters of negative GDP growth this year? I imagine this would get very political very quickly around the dinner table. Short answer is not yet. Do you want the longer answer? They give you the NBER, technical definition of what a actual recession is. Is that what people are going to talk about around the Christmas table?
I get yelled at
for
this.
You talk about recession and definitions of
One day I brought the FT to the Thanksgiving table, and that didn't go over well. But
you sat there
we'll
and
talk
read
about
it.
I had to finish it. Jillian Tett had a brilliant article, and I had to finish reading it. I look, John, at the recession discussion at the table, and they'll go the recession, and they go, yeah, we're pulling back. Let's lighten up on Bottega Veneta, and
that's a very unique. We would call that idiosyncratic. That it might be unique to you.
But I think it goes to retail sales, as we were talking to Megan about. I mean, it's a mystery. Remember, 6 months ago, Christmas is going to be terrible. We're all going to die. Is it?
Do you remember Omicron? It was 12 months ago.
Yeah.
Omicron.
And now in China,
That's what we talked about. Tom, that number, 211,000 jobless claims. That's the one that people struggle to explain.
And Chairman Powell said, there's the number.
Yeah.
He said that.
Ian Lingon coming up from BMO Capital Markets.
Watch.
That's next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's now up to the Justice Department to decide whether to prosecute Donald Trump for his role in the January 6th assault on the Capitol. A House committee voted unanimously to refer the former president for prosecution on 4 criminal offenses, including insurrection. In a radio interview, he called the January 6th committee a kangaroo court. A surprise move by the Bank of Japan. Governor Haruhiko Kuroda shocked markets by doubling a cap on 10-year yields. That sent the yen higher against the dollar. Many economists see the move as laying the groundwork for exiting a decade of extraordinary stimulus policy. Sam Bankman-Fried's preparations to be extradited to the U.S. appear to be back on track. The FTX co-founder told a judge in the Bahamas he'll end his fight to avoid being sent to the U.S. to face criminal charges for the collapse of his crypto empire. But his local lawyer said he wasn't aware of the plan. The hearing was adjourned and Bankman-Fried returned to jail. Now it appears that he and his lawyer are back on the same page. China is adding weight to the speculation that it's hiding the true picture of how many people have died since the end of the COVID-0 policy. Health officials confirm they have narrowed how they define a death caused by COVID. Only those people who tested positive for COVID and died of respiratory failure will be considered a virus death. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. The top names at the Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
The data are consistent with what we've been saying for months, that the U.S. probably started to enter into a recession at the close of the year, maybe early next year. We still have a recession call. We're probably going to see about 3/4 of negative GDP growth.
That was Dana Peterson there, the Conference Board chief economist on the outlook for 2023. More on that in just a moment. The BOJ making a shift overnight, moving its yield curve control, a new ceiling for that, 0.5% on the Japanese 10-year government bond yield. Yields higher today by 15 basis points, just short of that ceiling by about 10 basis points. But it shakes things up in the global bond market. The market looks like this. Equity futures, no drama. I have to keep repeating that because if you asked me to guess where equities would be on a day like today, I wouldn't have the S&P down 0.2%. That's why I'm not a trader and I'm sitting here, I guess, TK. Yields higher by 8 basis points on a 10-year, 366.39 on the US 10-year. Quote of the morning, without a doubt, from a Bloomberg subscriber, just to frame this moment from the Bank of Japan. The BOJ move, whenever it came, and it happens to be today, marks the end of the free money trade. The BOJ went first in, last out. First in, last out.
I really agree with the free money idea. You see it walking down 59th Street here, where finally we're seeing bank advertisements for yield. It's as micro as that for our listeners and viewers. It's as big as that at these major central banks. It's a world turned upside down. I'm going to say back 17 years, all of a sudden, money costs something.
Does it stick?
That's a key question.
I think without doubt, the question going into next year.
Not only does it stick on a static basis, but the dynamics of that involved. You got to talk to people that are really steeled in the history of the dynamics is seen, as Lisa would say, with the depth of the fixed income market.
We're talking about rate cuts in 23. Fed's saying, no, that's not going to happen.
I won't go there.
We'll see.
Just won't do
Someone's going to be wrong.
Parlor game.
Ian Linger's going to play the parlor game.
He's going to do it with us right now. We are thrilled at the quality of guests we have for you on this historic day, with the Bank of Japan capitulating towards a strategy like the Bank of England, the ECB, and the Fed as well. Dominic Constant with us earlier. Many people writing in, Alarian in the 9 o'clock hour. And now Ian Lingen with us, head of U.S. rate strategy at BMO Capital Markets. The good news is he can't draw a straight line. So Ben Jeffrey took the Technical Analysis Award from Institutional Investor, and his colleague Lingen picked up all the other pieces of economics and strategy in the fixed income space. Ian, what did you write this morning? First of all, congratulations on the II Love Fest. You've won it, I think, as many times as Ed Hyman, and you're a little bit younger. I want you to explain to us your first blush of this historic moment.
Well, thanks for the congratulations, Tom. I appreciate that. In terms of the Bank of Japan, I think the most surprising aspect of it from our perspective was, yes, the timing, but to some extent that they lasted this long. When we think about what the rest of the world has been engaged in over the course of 2022, it's been collective tightening. Coincident, perhaps, and not coordinated, but the fact of the matter is that Bank of Japan's now engaged.
I stole from the foreign exchange space. BMO Capital Markets pretty darn good there as well. With Greg Anderson, I look at the sterilized nature of this. We're going to make the move, but we're going to increase bond purchases 25%. Explain that but to us and what that means for global finance.
I think that their decision to increase the bond purchases was them implicitly acknowledging that someone's going to try to push that 50 basis point upper bound. And to do that, they're going to need to have the cash there to defend it. So that move was a bit more intuitive than I think that the headline might have otherwise implied.
How sustainable do you think this is?
So I think that the Bank of Japan is going to run up against the reality of needing to be more aggressive than they have been as the 2023 calendar unfolds, but I don't think it's going to be as quick as the market would like to see.
We're hearing genie's out of the bottle. Genie's out of the bottle. This BOJ gets tested. New governor comes in. They're going to have to make another move. How would you think about a new governor coming in? Kuroda exits. April happens. What does that look like?
From what I understand, the front runner to replace Kuroda for the Bank of Japan is very much in keeping with the overall mentality of the Bank of Japan. So I wouldn't expect any massive policy shifts, but even if that were the case, the groundwork has already been laid for a bit more of a hawkish move, and so I wouldn't be surprised to see out of negative rates sometime in the first half for the Bank of Japan.
Your shop has the advantage of Gallo, and he's reporting into Greg Anderson, who's just flat out legendary in tertiary foreign exchange analysis. I don't know if you've spoken to Mr. Anderson this morning, but the idea of a presumed glide path of strong yen from 150 to 132, modeling out 125 even lower, does he have a conviction that that glide path can sustain, or is it overplayed?
I think that his biggest takeaway is that momentum has shifted and that the progress toward the ultimate goal is going to be on autopilot to some extent. So I think there's high conviction on the glide path.
Will they have the economic might, the animal spirit of nominal or inflation adjusted, that dynamic of inflation of real GDP, to allow for these trends to occur and the unwind of their debt ownership?
Well, I do think that the trajectory that's currently in place suggests that there'll be very little problem getting there, although ultimately we need to see how the first quarter shapes up in Japan. We need to see what the impact from a reversal of the yen, if and when it eventually occurs, is going to be for inflation in Japan.
Have you changed your treasury call off the back of this? What does it mean for the treasury market?
We haven't changed our call. We still think 10-year yields in 2023 at 3%. I think that's a relatively benign forecast given where we are in the overall interest rate cycle. And the one thing that I would emphasize there is at the end of the day, that's a Fed credibility call because we have break-evens compressing back to levels that were in place prior to the pandemic. And the biggest risk is that the Fed, which we don't think they'll do this, but would be that the Fed gave up the 2% target. And we just don't see the path for them to do that.
Well, that's a longer conversation for another time. So 3 on 10s. Talk to me about where that is relative to Fed funds and the front end of the curve.
I think that the biggest surprise for 2023 is going to be the fact that both 2 and 10-year yields can trade well below effective Fed funds. We've already seen that start. That typically doesn't occur until we're later into the cycle and the Fed has reached terminal and terminal has been in place for a while. So we actually don't see any rate cuts in 2023, but we see deeper inversion of funds versus 2s and funds versus 10s.
Did you just say that the terminal rate is wherever it is and both 2s and 10s will be below that? Price up, yield down.
Absolutely. That's what's in place right now.
But you also implied it could be as much as 200 basis points.
And it historically has, precisely. And
so what's your 10-year path? What is your outlier on where the 10-year yield could be?
So if I'm wrong in one of 2 ways. One is I have underestimated the Fed's ability to keep policy on hold well into 2024. We're assuming they make it through 23, 24, they need to adjust and they start laying the groundwork for that. That would imply that there could be more upside, obviously, in the front end of the curve. The flip side being that we've underestimated the extent of the recession that we might see. We're looking for a more pedestrian, benign version of soft landing, but if we got that wrong, then you could see 2-handle on 10-year yields relatively easily.
Ian, I think you're brilliant. I've never seen someone so calmly explain something that is actually a monster call. I mean, it's a serious call. And Ian's so calm about explaining.
You know, and I had the great joy of knowing Fred Wiegold when he was at Bloomberg and, of course, at the Wall Street Journal. And these beauty contests are not a small matter. Institutional investor in the Wall Street Journal, the way they do the equity market contest. This is really, really hard. And part of it is not only making the call, it's a delivery. And Lingen does it, I believe it's in English, is what we call that.
Ian, thank you. Thank you, sir.
Ballet.
Ian Lingen there of BMO Capital Markets. Pushing forward now, in the next hour, we're going to catch up with Bloomberg's Mohammed Al-Arian of Bloomberg Opinion and, of course, of Queen's College, Cambridge. He's going to be alongside me for the hour, throwing questions at Mike Schumacher of Wells Fargo, Jack Caffrey of JP Morgan. We'll also be catching up, Tom, with Sarah Hunt of Alpine Saxon Woods.
She was very good last time.
Still to come in the next hour. You're going to drop by and join us?
I don't know what's scheduled.
Should I get you a seat?
People haven't told me.
You come by at the end of the hour and sit down with us if you want.
Yeah, you know.
Talk about the year ahead.
Wear a Detroit Lions jersey.
This was fun, wasn't it?
This was historic. Yeah, it's a big deal. Big deal. No question about it. Future's -11.
When I started, I had no idea it was going to turn into this. It's a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg Surveillance on radio and television. Thank you so much for being with us this morning. John Farrow, to drive the story forward, will be with us at 9 o'clock with a really, really interesting lineup to talk about the economics of financing investment of this historic day. If you're just tuning in, the Bank of Japan blinks. That will be the headline, the cliche of the morning, as we heard from many. The genie is out of the bottle. They decide that they will be not accommodative, and they move in some subtle and small way towards a restrictive policy in a unique Kuroda fashion. We'll continue our analysis of this, the impact on markets. We do so with futures at -10, Dow futures -31, and the VIX gives me nothing, 22.46. Oil, 75.96 on the American pricing, West Texas Intermediate. We've had a stellar lineup today, and we're absolutely thrilled to speak with Dominic Constam of Mizuho Bank today, and we continue that with this wonderful team at Mizuho under the leadership of Stephen Rasciuto, their chief U.S. economist. I do want to make very clear, folks, in the niceties of this, that neither Dr. Constam or Dr. Rasciuto speak for Mizuho Bank of Tokyo. They are with Mizuho U.S. in a research capacity. Stephen, your thoughts as we saw this announcement on the Bank of Japan. How does it redound over to the other three major central banks?
Well, I think the answer is pretty simple. It directly goes to the part that central banks are becoming more tolerant of higher interest rates, and they're becoming more tolerant of the idea that they need to move monetary policy into a more restrictive territory in order to contain the inflation environment that was unleashed as a result of COVID and the stimulus that was provided as a result of the COVID environment. And I think that's really the critical issue for markets here, is that central banks are going to be pushing higher for longer, and I think that really drives the direction of markets over time.
Can you predict the path of inflation, disinflation, deflation, or dare I say, reflation? Can you predict what price does?
Yeah, well, we know several things happen. When we have a tight labor market, we know we're going to have inflationary biases. The central bank, the Federal Reserve, is attempting to try to ease those inflation pressures from the labor market by trying to create a better balance between the underlying supply and demand for labor. Now, at this particular juncture, there's no evidence that they've accomplished that yet. At the same time, you do have this environment where global excess supply still exists, and the global economy is likely to be heading into a recessionary path. So you do have an increased possibility in here for some deflationary forces to resurface at some point later in the calendar. But again, that depends on how quickly the Fed can adjust the imbalances in the labor market.
This is really important, and your colleague, Dr. Constam, did mention this for Tokyo. Bring it back to Washington and across America. Do we see next year, Stephen Rasciuto, an imported disinflation that will assist Chairman Powell?
Well, we're seeing that already. If you look at the degree that goods prices are coming down after the very, very strong currency. Remember, your Bloomberg DXY index peaked at the 115 level. We're now, below the 105 level, which we put as the bottom end of the range. So therefore, there is some potential in here for the currency to help bring down goods prices. We're already seeing that when you look at the Cleveland Fed flexible versus sticky inflation numbers, the flexible numbers, which are largely geared off of tradable goods prices and commodity prices, have been coming down very, very rapidly. Now the key is whether or not those sticky prices, the service-related components, the 55% of CPI that the chairman implied are related to wages, how quickly that begins to reverse.
That was a clinic, folks, and what Chairman Powell mentioned, I thought it was buried within the press conference, but I'm a big, big fan of the work of President Mester and the heritage of Cleveland inflation series. They have 2 series. It's a bit confusing, but when you look at those series and bring them back to the listeners and the viewers of this program, Stephen Rasciuto, is there a feeling there that wages, that 55% of services can come in? I don't see evidence of that yet.
No, I don't either, and that's why you look at the labor market. And the key thing, everyone wants to ignore the payroll employment numbers and find excuses why payroll employment doesn't matter. But the payroll employment numbers fit very, very nicely with what we're seeing in terms of the initial unemployment claims number, which, again, we'll be getting another update on this week. And that'll help set the stage for what we estimate for the next payroll employment number that comes out shortly in the new year. And I think what we're going to discover is that labor market remains very, very tight. You saw it in the JOLTS numbers. We'll be getting new updated JOLTS numbers in a week or so. Those numbers are going to continue to show us that this labor market has an imbalance, and the imbalance is towards a shortage of workers relative to the demand for workers. And we don't see any evidence in terms of wage demands that we're starting to see any kind of easing up in the labor market environment. And this again drives home the point as to why we believe we need to have short-term interest rates higher for longer.
On radio and television, this historic day, the Bank of Japan acts. We have Dominic Constant with us earlier from Mizuho and his colleague Stephen Rasciuto. Now, just thrilled to have both of these people with decades of experience with us. Stephen, if that's the case, if we get wages not to move, to disinflate, if you will, if we get an unemployment rate that maybe doesn't go up like the hope and prayer, what is the chairman of the Fed to do?
Well, I think he follows the path he's laid out, which is more gradually raise interest rates over time, creating eventually a shallow but longer recession. Everyone in the market is convinced that the Fed's tightening is going to create some kind of credit crunch that's lurking just under the surface. We see no evidence that there is that credit crunch lying under the surface. And as a result, we think you're going to wind up with higher for longer in terms of short-term interest rates and a long but shallow recessionary environment. Over time, it will take the pressures off the labor market environment, and over time, it'll allow inflation to resettle to lower levels, which is why with regard to your previous guest commentary at the long end of the curve, I still believe rates are going to be higher at the long end of the curve than his very optimistic 3% forecast was.
I mean, this is the debate that's out there, folks. I don't know which way it's going to cut, but it's interesting to see, to say the least. Stephen, if we launch into 2023 and everybody's playing the Fed parlor game, I don't think there's been enough talk, my own opinion, of how alone the United States is with institutional success. Our policy success relative to Europe in a war, the United Kingdom, a tangential war plus their own challenges, and the challenges of China and Japan. Shouldn't we be taking a victory lap right now, or how we've gotten through 22?
Well, I certainly think so. But again, this is what's kind of reflected in the currency. We've had a very, very upbeat currency environment, even though we have lost from the 115 to the 105 level. The currency is well off the lows that we had been experiencing, or the downdraft people had been expecting. As we went into the 2022, 2023 environment, and I think, in this environment, as we move forward in here, I think the currency is reflecting the fact that from an energy perspective, we're in a much better position than our colleagues are overseas. And I think that is a key driving motivation. When you look at the contrast between the U.S. in the 70s and Europe in the 70s versus U.S. here in the 20s versus Europe in the 2020s, we were at the energy problem in the 70s. We're at the Europe is at the energy problem peak this time through, and I think in that environment, it really sets the tone for why European currencies are going to, the euro is going to be weaker than the dollar is going to be, and that really drives home the point as to if you're going to be in one of these two markets, which one would you rather be? The answer is pretty clearly you'd rather be in the dollar markets.
So, Stephen, just a basic question. Stephen Rasciuto, is the pandemic over?
I believe the pandemic is over. I believe the bulk of the supply chain related issue is over. You just have to look at the freight rates. You have to look at the the transportation of goods, the reduction in backlogs of ships leaving off Los Angeles and Port Newark. All that is over and done with. You know, freight rates will probably never go back to the lows prior to COVID because we've had to use new fuels that are more expensive and less efficient to burn on a lot of these ships that bring these containers across the water. But again, we've reversed almost all of that. So I think from the supply chain related issues, and that's what you're seeing in terms of the commodity price numbers, yes, the pandemic is over.
A couple of questions here, Stephen, to finish on consumption. The holiday season, as we stagger into, I guess everything's on sale now, Steve, which means in January it's going to be on more sale as well. Stephen, you can fix your tie on TV, folks. Rasciuto's fixing his tie.
I'm
so
sorry,
I'm going to fix
having
my
a little
tie.
trouble here.
You know, I have trouble every day, Stephen. This show you don't have to fix your tie. Whether the consumer and what are we going to look like in consumption in February as we go into Q1 March?
I think what you're going to see in terms of the consumption numbers is basically that as long as the labor market is firm, and I think it will be in February, you know, it's wages that drive the overall consumer spending numbers, not the interest rate environment. And when people have jobs and they feel comfortable in their jobs, they're willing to spend and they're willing to take on credit. So I think you're going to be looking at a more resilient consumer than a lot of other of my colleagues on the street are anticipating, again, because I still believe we do have a very tight labor market, and I think that will dominate over the interest rate story.
Stephen, to come back to the moment at hand in the Bank of Japan, does this change anything for Chairman Powell? Forget about the speaking derby and the dot plot analysis. Does this change February 1st for Chairman Powell?
I don't think it does. I mean, this is something that the markets have been anticipating for a while. We all knew it was going to happen. We were just waiting for it to happen. We assumed it would happen shortly after Kuroda left office. Instead, he decided to pull the plug and give them what they wanted earlier. Again, I think all it does is lead us to an environment where the currency finds a floor, and that just puts us in a better position for the chairman to assess where we're going on goods basis, on a goods price basis going forward, now that we know that we've probably set the floor in on the currency.
Stephen, thank you so much, and thank you to all of Mizuho USA for your input today, along with Dominic Kostum. Rasciuto and Kostum at Mizuho. Again, I really want to make clear they're not speaking for the Japanese bank on this historic day for Tokyo. They are in a research capacity in New York. What we can see, and John has mentioned this earlier, folks, really remarkable in the market, like maybe you would think into this holiday week. I would note Bitcoin with a bid 16,800, but where you do see it is in foreign exchange, a dollar weaker by some amount. Yen 132.42 is in 4 big figures. To get to 5 big figures would be a big deal, not quite yet there. Stronger Japanese yen as well. Euro yen shows the same kind of dynamic, almost exactly to the 100th point, 140.53 on Euro yen as well. We are going to continue. There is so much to talk about here on Japan, on Tokyo, but also on setting up for next year, given your ability to look at your 201k envelope. Ritholtz next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After a 17-month investigation, a House committee has recommended Donald Trump be prosecuted for his role in the January 6th assault on the U.S. Capitol. It's now up to the Justice Department to decide whether to hold legal proceedings against the former president on 4 criminal offenses, including insurrection. Another House committee is scheduled to meet today to consider publicly releasing 6 years of Trump's tax returns. Negotiators in Congress have agreed to a $1.7 trillion spending bill. Now they'll try to send it through the House and Senate to avert a government shutdown on Christmas Eve. The bill provides funding for government agencies through next September. It also includes more than $45 billion in aid to Ukraine. In a new Bloomberg poll, economists say there's a 7 in 10 likelihood that the U.S. economy will sink into a recession next year. That's more than double what it was 6 months ago. Estimates call for gross domestic product to rise 0.3%. Meanwhile, consumer spending, which accounts for about 2/3 of GDP, is expected to barely grow in the middle half of the year. Ukraine has reached a deal with Elon Musk's SpaceX to receive thousands more Starlink antennas. Now, they'll be used to counter Russian air attacks. More than 10,000 of the antennas will be sent to Ukraine in the coming months. They provide internet service beamed down from satellites. And Amazon has agreed to settle European Union antitrust investigations. Regulators accepted the company's promise to stop using non-public data on independent sellers on its marketplace for its competing retail business. The agreement also includes offering equal access to Amazon's Buy Box and Prime services. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Discussion becomes how deep a recession, what is the impact on earnings, and what do we see during 4Q? I mean, if you look at it next month, I think there's two really important catalysts. One is January 6th, because I think the average hourly earning component of the labor report is going to be hugely important. And the second is what happens in 4Q.
Stuart Kaiser's Citigroup on fire yesterday with one of my pet themes, which is when it's as difficult as it is now, your choice set goes way down. There's fewer and fewer things to do, and you're supposed to be diversified because you read Barry Ritholtz's encyclopedic, and he says be diversified, except there's nothing to diversify into in a year like this. We've been talking about history today, the Bank of Japan, Fed policy, big picture things. This is the important 7, 8, 9 minutes we're going to do here with Mr. Ritholtz, of course, Masters in Business podcast, Chairman and Chief Executive Officer of Ritholtz and Fee, as it's called. What are you going to do forward with your 201K? Well, it was a 401K. Barry, everybody listening and watching is enjoying a 201K.
Well, 301K this year. Look, these storms come along occasionally. It's been 41 years since we've seen a market where equities and fixed income both had double-digit drops. It doesn't mean you throw your plan out the window. It doesn't mean you panic. There was literally no place to hide. All right, the dollar index, maybe. But you look at everything else, stocks, bonds, privates, venture capital, SPACs, the municipals. TIPS did okay, but not great considering the inflation run. Shortest duration bonds was really the only thing that had a little glimmer.
Of short duration,
right? And then small cap value has held up better than most. But pretty much wherever you look, it was a bad year.
Yes.
This happens every decade or so.
What is challenging here is the pandemic gets in the way of rational thought. How do you process, as one of our guests just said, yes, it is the end of the pandemic. Do you look at the end of the pandemic as a liftoff point to what you and I know is possible, which is where you get equities with big double-digit returns if the cards play out?
So here's a funny historical coincidence, and I don't put too much stock in these sort of things. The dot-com collapse bottoms out March 2003. The financial crisis bottoms out March 2009. Pretty much you set the low in the pandemic, March 2020. So maybe that same streak of luck happens and we continue to grind lower as people debate, is the Fed going to make a little mistake or a big mistake? Maybe if people come to realize, they're going to find religion and stop. By Q1, we could see a really great opportunity.
This is critical. Mike Wilson, Morgan Stanley, says ignore the Fed, look at earnings. The optimists out there say the same thing. Too much Fed talk, and they believe in an animal spirit of corporates. Are we all in our modern financial media and all of that? You're part of this. It's your fault as well, Barry. But are we all overanalyzing on the Fed? Are we navel-gazing Chairman Powell instead of looking at the power of corporate America?
So there is some element of truth to that we've all, listen, it's either all Elon Musk or all Jerome Powell, which is, I think, a step up from all Donald Trump, which is what we had a couple of years ago, and we need to focus on the many other elements. When you talk about earnings, we're talking about profitability of company, whether revenues are flat, rising, or falling. And that's why the focus is on the Federal Reserve. Look, this is the fastest rising rate regime we've ever seen.
Yes.
And you're seeing various sectors roll over. You're seeing housing roll over. That normally doesn't bode well for durable goods. We've seen energy, and here's the real crazy part of this whole thing. If I was Jerome Powell, I would stick my flag in the ground, declare victory, and go home. Wherever we look in the world of commodities and goods, prices peaked 6 months ago.
They're coming about half, if not more.
Coming down, substantially back.
Yeah.
So this is why people are Fed obsessed. Is the Fed going to are they going to stick the landing and get it perfect? I think that's a low probability outcome.
Right.
But is it a big mistake or a little mistake determines when we bottom.
I want to segue here, folks, to what Barry, and this is a little bit of inside baseball here. We look at return, you look at return at home, and maybe it's a bank account, compound return and all that. And then there's the industry of internal rate of return, which are some gnomes that keep a calculus at big accounting firms as well. And we talk about the private equity market, which has gone from large to ginormous. Huge impact, many of them on our shows with you on your wonderful podcast. How's their internal rate of return worked out this year? We don't know.
So here's the funny thing about privates. First, we're willing to lock up money for long periods of time as investors in privates.
That worked out with a guy in the Bahamas.
But because you get the illiquidity premium. There's a trade-off. You can invest in things that don't require daily liquidity. But then, and here's where IRR is so important, I get a mark on my public stocks and my public bonds every day, every tick.
Yeah.
Private equity, we'll get around to marking it up. The smaller, let's say, real estate firms, they'll do a quarter of their assets every quarter. So each year you get a full mark, and it's fairly current. But a lot of the other larger private equity shops, we'll get around to it. It's kind of funny when you see the privately traded REITs. They've held out great, and they're investing. When you see the privately traded REITs, they've held out great, and they're investing in the same things as the publicly traded REITs all of which have
Well,
seen a big hit.
We're going to rip up the script here. Let's go over there right now. Blackstone. Good morning, Steve Schwartzman, and all over at Blackstone that have invented the pooling and the ownership of different kinds of real estate. They've been articulate. They don't think they're moving the market. Not the social debate of it, Barry, but do we actually know what's the underlying at a firm like Blackstone or others in their private investments? The
Yeah,
answer is no.
they do a pretty good job giving you the broad strokes. It's not the same as buying a mutual fund where you can see every single holding. And you know, I think they kind of got raked over the coals. You look at the prospectus for BREIT, it tells you here are the liquidity gates. It's 2% a month or 5% a quarter, and that's it.
Totally agree.
And I don't understand why you know, it really matters who your co-investors are. And I think the problem is they had a lot of retail brokers who assumed I'll be able to get my money out, and you can't do that. But that said, it's private, which means it's different disclosure rules, it's different transparency rules. They have put together BREIT as an example. What is it, 16% annually for 30 years? That's a hell of a track record.
It's a grim year. Barry wore in his Christmas sweater, and it's not going so well. It's a plain green. It's a lovely sweater. It's not the Christmas thing we're used to. Barry, let me cut to the chase. Active is percolating. The 2023 will be a better year for active. You and I have heard this
every year.
That's the first time.
Every year. Yeah. Listen, the beauty of people like Warren Buffett and Howard Marks and Bose Weinstein, and go down the list, is they're outliers. They're the Lionel Messis and the Michael Jordans of investing. And, you know, we all want to be like Mike. We all want to be able to nail that penalty shot. But the vast majority of us can't. And so the tease of seeing those rare outliers who figure out a way how to be active, the academic literature is overwhelming. After a decade, net of fees, it's way north of 90% fail to meet their benchmark. And so the smartest thing investors can do is make sure at least their core portfolio, pick a number, 60, 65, 70%, is broad, low-cost indexes. And if they want to play around the edges, feel free, but you want to put the statistics and probability on your side.
Barry, Mohammed emails in and says, ask Barry about those jets. How about those jets?
You know, really? Really? I mean, it's just...
It's painful.
And it always has been. I think the Jets might be the second worst management in sports, only after the Dolans and the Knicks. If you really want to see terrible, terrible ownership, you have to look at Dolan. And true story, I once pulled aside a mutual friend whose name is on this building and said, do us all a public service. Please buy the Knicks away from the Dolans. The city would thank you forever.
I'll brief the 108th mayor of New York on that at some point. Mr. Ritholtz, thank you so much. And I would point out that the guy with the name in the building has a little bit to do with Bloomberg Television and Bloomberg Radio as well. Barry Ritholtz with a really important conversation there on a nation. And, you know, I've been big on this, folks. I'm not going to mince words. It has been underplayed. The losses taken in the bond market this year from the short duration that Mr. Ritholtz talks about out to medium and long term. It has been truly a migration to a 201K. I can't say enough about the importance in the next hour on radio and television of this historic moment with the Bank of Japan this morning. Futures at -7, red and green on the screen. Stay with us. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist. And I think we are witnessing right now a societal change in the way we work. You're no longer going to measure productivity in the same way as in the past. You're going to be focusing on outputs. Never mind what people do in their private times. It doesn't really matter to a company as long as the output is there.
HPE launched its Edge to Office hybrid work initiative in the fall of 2020. The new campus is designed with that flexible model in mind.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Live from New York City this morning. Good morning, good morning. 4-day losing streak on the S&P 500, down 5% over those 4 days. Can we snap that? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, another central bank surprise. Governor Kuroda shifting the BOJ's cap on yields. Government bonds drop and the yen surges as the Widowmaker finally delivers.
This was a shock. Shocked by the moves overnight. Bank of Japan tends to like surprises.
No, and then bang, here we go, you get the move.
The genie's out of the bottle here. Genie's out of the bottle. This is the first step of many. Very sharp reaction in the market and could lead to real shocks day after day and week after week.
Upward yield pressure across the board.
We're seeing these yield rises.
The pressure on Treasury yields is going to be higher.
We're looking for 4% on US 10s.
People might risk reading a little bit too much into it.
Yields will need to rise in Q1. Every central bank around the world is literally adding to market volatility. We're on the pathway to normalization, and the market is going to be pretty volatile as we progress along that path. It's a tough road to travel for the investors.
Tremendous reaction to that story overnight. As we count you down to the opening bell, I'm really pleased to say that joining us around the table is Mohammed Al-Erin of Queen's College, Cambridge, and of course the Bloomberg Opinion. Mohammed, good morning. It's finally happened.
It is the start of a process. Yes, it has finally happened.
You warned about it back in October in a column in the Financial Times. I believe it was right at the very end of October. You said this looms large over the market. We have a new range, a new band for the BOJ. The upper range, the upper limit of that band is now 0.5. We haven't tested that today. For me, this hasn't had the reaction I thought it would have in global markets. You think this is what would take place based on what you've seen so far?
Yes. Look, what they're trying to do is an orderly, slow exit from an unsustainable monetary policy regime. Now, they can't say that, but that's what they're trying to do. So they did two things today that were quite smart, John. First, they increased QE. They're basically telling you, if you want to test the 50 basis points, come to me, and I can absorb as many bonds as you want to sell. So the first thing they're trying to do is no immediate testing of the ceiling. Second, they've chosen a low liquidity period to do this. Again, pretty smart. Now, The good news for them is I think they can control the process. That's actually good news for global markets because it doesn't force selling by Japanese institutions. However, over time, even this approach becomes unsustainable.
There's a ton we need to work through. The question I've asked all morning, and you've heard me ask it, so let me ask it of you. Do you believe this is a step towards normalization? Or is this the BOJ, and that's what they're trying to signal communicate this morning, basically resetting policy on a more sustainable path? They're very different things. Which one is it?
It's absolutely the former. There's no doubt in my mind that this is the step towards normalization, but they're trying to make it a really long process, as unexciting as possible, so that it doesn't force selling by Japanese institutions. That's the big risk, and they've learned it from what happened in the UK. They've seen what happens in the UK when you shock the government bond market. When people have already optimized a low-yielding environment, they don't want this to happen. So yes, this is the beginning of the process. The genie's out of the bottle, or whatever you want to call it, right? You've heard that phrase all day, but it's going to be, they're going to attempt a very slow process.
I've heard pretty much everyone say the same thing on this, and it's interesting to me because the firms that were short the JGB market looking for this move, they're still short. You hear that from Schroders. Schroders say the market will now pressure the BOJ. We're adding to our short position and building our position in the yen. This has more legs. We're on it. Bluebay said the same thing on Bloomberg TV this morning, although it's a small shift in the band. The genie is out of the bottle. There it is again. We will stick with our short JGB positions for the moment. Can you walk me through how you think this plays out from here? Is this a market that tests the limit of that upper band or respects it and waits for the BOJ's next move? How do you think this plays out?
So I think in the very short term, it respects it. But there's a problem, John, which is that they are breaking their government bond market. So the notion of taking on more and more JGB on the balance sheet is not a sustainable notion at all. Already they own, as you know, a very high percentage of their government bond issuance. And that breaks one of the most critical markets in your ecosystem. So over the short term, I think that they can withstand testing, but over the long term, they're going to exit, and there's a risk of a disorderly exit.
Well, let's talk about what a disorderly exit looks like. What do you think that looks like? How does that play out? When you say it's breaking, what does that actually look like?
So think of a system that has optimized very, very low yields forever, and you start shocking it by higher yields. So how do you optimize a low yield? You basically lever some other risk factor. In the UK, the pension system levered the interest rate factor. In Japan, they have levered foreign credit. So if you look at ownership of all sorts of foreign securities, high ownership in Japan. So what everybody's worried about is the forced selling by Japanese institutions as they have to get back on side because the JGB side of the trade is losing money.
Go on.
So I think this is what you have to look at, and you have to understand what they're holding, and you have to understand the contagion, but it's not going to play out quickly. It's going to play out over time.
There is a phrase that you used in your FT piece in late October, what happens in Japan stays in Japan. And I want to read out the quote for the audience at home that may not have read that piece. Japan's influence on the global economy and markets gradually declined. What happens in Japan stays in Japan became the mantra for many, but this could change if the Japanese authorities do not prepare well for what increasingly looks like an inevitable exit from its yield curve control policy. Now, yield curve control sticks, but it shifts. What happens in Japan stays in Japan. I can already hear you pushing back against that. So this year we've had a 200 basis point plus move on the US 10-year, the German 10-year, the UK 10-year. Before today, the Japanese 10-year has been totally unchanged. Do I think of this as the Japanese 10-year playing catch-up, or does that Japanese move push those others as well?
Both. So you think of it as Japanese playing partial catch-up. They're not going to move to 100 basis points. Their economy is in a completely different place compared to the US in particular. But it is going to push other yields higher. And that's the problem for the marketplace. We had a very orderly process. We thought this year is about interest rate risk. We get it out of the way. The Fed catches up, the ECB catch up, and now we can get rid of interest rate risk. And next year will be about credit risk, about recession. What we're now learning is interest rate risk is not out of the way at all. And now we have to look at next year navigating both interest rate risk and credit risk. And that is why markets have been so jittery over the last few days.
Well, let's talk about 2023 and the interest rate risk that still exists. I got the greatest quote this morning, and I can't share with you who it came from because they won't allow me to, but I'm happy to share the quote. This individual said to me over the Bloomberg terminal, to me the BOJ move, whenever it came, and it happens to be today, marks the end of the free money trade. The BOJ went first in, it's the last out. My initial reaction to those words is, okay, but does it stick? Is this something we exit from and live in a brand new world and stay there for a while, or are we just going all the way back to where we came from, pre-pandemic? What is it?
We are not going back to where we came from. We're not going back to where we came from for many reasons. One was the unintended consequences of a ridiculous regime of very low interest rates and infinite QE, so we're not going there. Inflation is not going to come down in an orderly fashion. We're going to get sticky inflation. When we get to 4%, there's going to be a major decision to be made by society as to what to do next. So no, we are not going to the old regime. We are exiting one regime and entering another regime of money being priced more appropriately.
Sarah House of Wells Fargo talked about the last mile, from 5% down towards 2%. We're making this move from close to double digits to 7, back to 5. They feel like easy hurdles, disinflation's here. But Michael at JP Morgan said something interesting recently. I'd love to get your response to it. He said, is the recent disinflation transitory? Do we get down to like 5 and then we're sitting there staring at that final mile and realizing how tough it is to get back down to 2? Is that how you see this playing out?
Yeah, I don't know if it's 5, but certainly 4. So you've got to understand the inflation transition. It started out as very concentrated in energy and food. Then it shifted to the goods sector. At that point, the central banks could have controlled it, but they didn't. They were late. So now it's gone into the service sector. So 2 things happen. One is the goods sector disinflates for now, but that's going to stop at a certain point. Meanwhile, service inflation is much more sticky. It is much less sensitive to interest rates. So what you get is that disinflation is in fact transitory, he's right, and then the service and wage inflation becomes an issue. That is the transition we're looking at next year, and that suggests that we're going to get stuck at around 4%.
So Fed says mission incomplete. They project 5% Fed funds. Markets saying rate cuts. Which one do we get?
Yeah, and that's the big question mark, and that goes to the recession call. Do you believe the recession will be short and shallow? If you believe the short and shallow, then you would opt for the Fed 5%. If you believe that if we fall into recession, which we're likely to be, it will not be short and shallow, then the marketplace is more correct than that we're going to see a change in the interest rate regime. It all comes down to a recession call.
What are you leaning into?
I don't know, John. Just like I warned against people saying inflation was transitory, I warn against people immediately saying, oh, if we're in a recession, it'll be short and shallow. We have to understand the behavioral aspects of this. If I deliver bad news to you, the very first thing you'll do is try to reframe it as good news. So last year it was inflation is going to be a problem. No, don't worry, it's transitory. Now, people saying recession is going to be an issue. The answer is don't worry, they're going to be short and shallow. We don't know. There's lots of open questions. We simply don't know what a recession will look like.
So in February, the Fed's got to set policy. They don't know either. What's the optimal policy response, given that you don't have a clue either what next year looks like?
So they've got to get inflation under control. I mean, they have no choice. There will be collateral damage. There will be undue damage to the well-being of society because they are so late. But I agree with Chair Powell that the risk of not doing enough exceeds the risk of doing what you need to do.
Do you think he still believes that?
I do.
Because I got a sense that that balance of risk for him has shifted in the last couple of times he spoke. Do you still think that the risks are that asymmetric into next year?
Do I think it? Yes. Do I think the Fed thinks it? Yes. When you have 17 out of 19 FOMC participants predicting a Fed funds rate of over 5%,
yeah,
that has a lot of information content.
We've got to talk about the price we're going to pay for this. You mentioned some of the pain. Chairman Powell warned about it at the end of August. Neil Ferguson wrote a piece on Bloomberg Opinion, and I'll say this so you don't have to, but Neil's pieces are like, 2 hours long. I got through it. And there was an interesting line in there from Neil. There always is one. The second fastest hiking cycle since World War II. The prices that we're going to have to pay for that, both on the market side and the economic side. And can we start with the markets first? I'm struggling to get my hands around the idea that you can have 400 basis points of tightening in 9 months, and the price we're going to pay for blowing up a decade of loose policy is 20% on the S&P. Just 20% on the S&P, and that's it. We move on. Things get better next year. Do you believe that that's the price that we're going to pay for a tightening cycle this fast, this quick?
So first, as an investor, you've paid more than that. You've paid your loss on your risk assets. You've paid a complete erosion of any risk mitigation in the diversified portfolio. That is big, John. The fact that there was nowhere to hide for a whole year, that's a big issue. And then you've also had unsettling volatility, which makes people do silly things. So it's not just returns, it's returns, correlation, and volatility that have hit you in a big way. Is it done? No, it's not. That's why I'm saying, the hope had been that interest rate risk would be behind us, but we are paying for the consequence. We're paying the consequences of the Fed being late. The front-loaded interest rate cycle is a big deal. You cannot shock a system with such front-loaded rate hikes without collateral damage. Just remember that.
You're going to stick with us for the hour?
I am.
This is good. You get to read a couple of teasers along the way as well. I'm looking forward to that. Coming up, why Morgan Stanley thinks we're about to confront real profit pain.
The spread between our forecast now and what the consensus is modeling for next year is as wide as we have seen since the summer of '08. We're looking for an earnings recession.
That conversation up next with JP Morgan's Jack Caffrey, Mike Schumacher of Wells Fargo, and the wonderful, the brilliant Mohammed Al-Arian.
Consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
Spread between our forecast now and what the consensus is modeling for next year is as wide as we have seen since the summer of '08. We're looking for an earnings recession, and we're just putting this warning out for folks who assume the market is omnipotent and it knows this. The market typically doesn't know these types of earnings declines before they happen. We've been in this sort of 3,000 to 3,300 range, and we think that's still the path. And I would say that we now believe we could get to the lower end of that path.
Morgan Stanley seeing earnings pain ahead, warning of a potential decline back down to 3,000 on the S&P 500. Strategists taking their position for next year. The median year-end target for the S&P 500, 4075, less than 300 points away from current levels. Joining us now to discuss is JP Morgan's Jack Caffrey, alongside Mike Schumacher of Wells Fargo, and Mohammed Al-Arian, and with us around a table here in New York. Jack, I want to go first to you. Can you envision a scenario that sees a low of 3,000 on the S&P early next year?
I can. It tends to be a nightmare at 2 in the morning, and I wake up screaming. But, ultimately this comes down to where I think part of the issue that you get there is we do need to find something new and shocking. I don't have enough fixed income experience to know if what Bank of Japan is doing to us this morning qualifies in that new and shocking, but it does involve, in all likelihood, some sort of substantial disruptive issue, and I would think comes out of what has historically been perceived as a safe asset. So I'll come back to government bonds behaving like they're not a safe asset. A, and then B, a potential push through of inflation that becomes perceived as uncontrolled.
Well, Mike Wilson's got a massive earnings warning in there as well. So you've got an earnings warning, and couple it with this, Jack. This from Mike Schumacher. And Mike, I don't know if Jack's going to find this shocking, but I want your view on why you got here. The 10-year real yield you see back at 175 in 3 months. Mike, you go on to say that nominal yields on a 2-year get back to the high 4s, on a 10-year get back to 425. Mike Schumacher, how did we get there?
Made some progress that way today, John. So the Bank of Japan's helped out, joining the party, perhaps a little bit late. And the other way you get there is that inflation comes down. I think we'd all accept that, but remains fairly sticky. Neil Mohammed had a great discussion about equilibrium rates. Do they turn out to be 3.25, 350, or 275 in the U.S.? That last mile that Sarah House referred to is critical. And if it turns out to be 3+, the Fed's got a lot more work to do. That pushes up real yields across the curve and sends the 10-year skyward.
So, Mike, add to that your growth outlook. What do you think growth looks like next year for the U.S.?
Yeah, our econ team, Mohammed, is in the mild recession camp, and it's a consensus. It's a little too comfortable, I think, for a lot of people. So I have concerns about that. And I think that the thing we've all learned this year is humility is the order of the day. So I like to think of it in terms of a risk management type of scenario. Is there a chance the U.S. escapes pretty well and the rest of the world does? I suppose. Is there a decent chance also a tail risk that it's much more severe? Yes. And I think the tail risk is going to drive markets.
Mohammed, you've talked about that humility, the need for it going into 2023. It's been the lesson of the last couple of years, hasn't it?
Oh, absolutely. I think we've understood that there's many potential outcomes, which takes me to Jack. Jack, the last thing I want you to do is to wake up at 3 o'clock in the morning. But when you hear Mike, don't you worry that you will be waking up at 3 o'clock in the morning? Why is Mike wrong?
I don't know that Mike is wrong. I would say, in my career, 30 years of trying to earn this gray hair, in most of my life, the first 20 years of that, long interest rates were similar to nominal GDP. And even in that scenario, Mike's interest rate forecast for the 10-year looks relatively low against certainly a shallow, briefer inflation. Certainly when I look at the equity market, you are seeing some interesting toggles between how traders are trying to position for their recession call. Look at the relative weakness of bank stocks versus the relative strength of home building stocks. When you do see certainly very bombed out sectors, stocks that are trading at 3 times earnings and 75, 80% of book value, you start asking, is this cheap enough? Does this reflect enough? You look at banks, they look cheap-ish, but there's a question of what do credit losses look like? And unfortunately, we're probably in a corporate quiet period for the next, call it 2 to 3 weeks, actually probably the next month, before we actually get some real commentary out of companies what their year looks like, not their quarter. And I think investors are probably going to set up, equity investors will have to set up pins and needles until they can get some better calibration of what that earnings risk might look like.
Jack, that's why the 13th is so important to so many people, because we have January 6th, which is payrolls, the 12th CPI, and then the banks kick things off on the 13th. Jack, do you get the feeling we get that kitchen sink moment that Mike Wilson is looking for? Is that kitchen sink moment going to be delayed next year?
Yeah, equity investors generally prefer the kitchen sink, and then they can say, we're done. It's for us to look through. I do think that we're going to have ongoing, we think about valuation pressure. There's what's the E, and then what's the P you want to put on that E. And I think that's the question where equity investors have certainly preferred kitchen sinking results. There's a long history of it. The challenge, though, is we're much better as a group of human investors when you get one kitchen sink, not 5 or 6 companies kitchen sink all on the same day. And I think that's where the front-loaded nature of A, earnings, and B, bank earnings being relatively earning will make the earnings season very interesting. And that gets you that setup that I think many strategists are calling for, which is, a 300 to 400 point gain from here. But there's a general view that there's a lot of pain in that first quarter, if not first half of the year. And I think Mike Wilson puts himself in that category as well.
Mike, can Jack sleep better because it's not just about absolutes, but it's also about relative. And when you look at the US, we are the cleanest dirty shirt around the world. We don't have the stagflationary pressures that Europe is going to face. We don't have the complicated exit from zero COVID that China has, the exit that from yield curve control that Japan has. So if you look in relative terms, the US looks more attractive, and that avoids Jack having to wake up at 3 o'clock in the morning. What do you say to that?
It's a fair point, Mohammed, but it's interesting. When you think about the market reaction after the ECB, Christine Lagarde was awfully hawkish. It sent shockwaves through global markets for sure, certainly into the U.S. And that tells me the U.S. is not insulated. So yes, it may be the cleanest dirty shirt. It's probably a good metaphor, but it doesn't necessarily mean it's a shirt you want to put on right now. I think it probably has to go through the rinse cycle a couple more times. Maybe you wait till March, April, something like that, and then get more comfortable. So it's too soon for that, in my opinion.
Hey, Mike, amazing calls. Mike Schumacher there and Jack Caffrey. Mohammed's going to stick with us. Mohammed, President Lagarde, where did that come from? Last week. That was the Uberhawk last week, wasn't it?
It was. It was. And Mike is absolutely right. It really had an impact on U.S. markets.
Oh, big time. Coming up, the morning calls and later. Earnings estimates still remain too high. That's the warning from Sarah Hunt of Alpine Saxon Woods. That conversation coming up shortly.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
About 5 minutes away from the opening bell, equities down just 1/3% on the S&P. Let's get you some morning calls. First up, JP Morgan downgrading Whirlpool to neutral, saying margin concerns will continue due to the highly promotional environment. Your second call from Deutsche Bank downgrading Spirit Airlines to hold, expecting the stock to be range bound until regulators approve its JetBlue merger. That stock down about 1%. And finally, Evercore and Mizuho cutting their price targets on Tesla. The analysts both citing demand concerns. That stock down another 2%. Coming up, Sarah Hunt sounding the alarm on US profits, joining a growing chorus on Wall Street. That conversation up next.
much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Part of what I love about business is you get to build things from nothing. I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
If I told you the debate between Kelly Lyons, Mohammed and myself in a commercial break, you wouldn't believe me. Your equity market right now down 0.2% on the S&P. On the Nasdaq, down 0.5%. Coming into today, down for 4 straight sessions on the S&P 500. Over that time period, down about 5%. Get up in the bell ring, switch on the board and get to the bond market. 10-year yield shaping up as follows. On a 10-year at the moment, up by 10 basis points. On a 10-year Treasury to 368.81. In the FX market, euro dollar 106.15. Crude up 0.5% to 75.55. I have to say, so far no drama, even with that move in the bond market. Mohammed, tons of reaction to the conversation we had around the BOJ a little bit earlier. I'll quote an individual off the Bloomberg who's written in. They say you're right. The issue is more about the second-order effects of markets that were leveraged to a low and stable yield environment and low-yielding trades. How long is that going to take to play out? Clearly, we've blown things up this year. Is that a story we have to reckon with in 23?
I think we have to reckon with it, but not to the extent that we did this year. I mean, we're going to see a lot of this in the private market segment. That hasn't repriced yet compared to what has happened in public markets. So this is a continuing issue, not as intense as this year, but it's not all done yet.
One to watch in 23, one stock to watch around the opening bell is Nike. Earnings coming after the closing bell with a host of results coming throughout the week. Nike, not the only one. Abby has more. Morning, Abby.
Hey, John. Well, yes, this is a key report after the bell today, and it's an important earnings report for a couple of reasons. First, it will provide an important tell or look on the U.S. consumer, and it's also going to provide a key critical look at China. So starting out with the China piece, that's about 25% of their sales. In the last couple of quarters, if you recall, have been challenging. Growth has slowed to about 13%, down from the high teens. This on, of course, the COVID zero policy really hitting consumer spending there. So folks wondering, will it improve? Is there going to be a more positive read? Now, relative to the U.S., it's a similar situation outside of the COVID policy. It has more to do with whether or not the U.S. consumer has spending really slowed amid inflation. What does this mean for inventories? Because it's really pretty amazing. Their inventories at basically record levels, really ballooning like so many other companies. It's not all negative, though, John. At least some analysts, Jefferies including, saying that they are cautiously optimistic, that they think the estimates are achievable. Easing lockdowns in particular, China could actually be a bright spot. Their move to digital, the women's category, and then again, China, because it has been down in a trough, maybe that is going to be what could bolster their outlook to some degree, John.
Abby, thank you. Nike want to watch. FedEx, another one, reporting after the close. Who remembers this from 3 months ago? The company's CEO laying out the challenging conditions back in September, writing, quote, global volumes declined as macroeconomic trends significantly worsened later in the quarter, both internationally and in the US. Deutsche Bank called the results last quarter the worst miss they've seen in their 20 years of analyzing companies. And Katie Lyons, we're wondering whether we get a repeat.
Yeah, if we get spooked once more, because we definitely saw a big spooking of investors 3 months ago when FedEx warned about those worsening business conditions in multiple markets. And since then, in the months that have followed, other shipping companies have come out and warned about macroeconomic headwinds and waning consumer interest in e-commerce. So this is going to be a really key tell on a key shipping season. FedEx ahead of these results, down about 1% at the opening bell. And of course, it's already down 35% this year, underperforming the broader market. The focus really this quarter is going to be on profitability and margins, which have narrowed due to the cost pressures that FedEx is facing on everything from fuel to labor. And that is why progress on cost cuts is going to be something we're looking for. About $700 million in savings are expected in this quarter. The company began furloughing employees, parking planes, part of a multi-billion-dollar long-term cost-cutting plan. All of that kind of on the expense and supply side, but we have to deal with the demand side as well. And that is where we look at anticipated shipping volumes. They are expected to drop across the board. Ground seen down about 4%, freight just a little bit more, and express, which is critical, it's the largest revenue contributor, made up about half of sales last quarter, is expected to see the biggest decline, down nearly 11%, is what analysts anticipate, John.
So, Kaylee, inquiring minds want to know, so let's share it. So, TK's never seen Trading Places, never watched Rocky. What else was there? Never had watched Top Gun, or Titanic for that matter either.
Criminal.
And Kaylee and Mohammed are having a conversation in the break as to whether Leo could have fitted on that piece of wood. What was it, a door that he shared with Kate Winslet in Titanic?
I think the correct argument is not if he could have fit, there was room. It's if it would have floated had he joined her on the float. And that is what I think
I totally agree with Kaylee. Kaylee
Lights.
Totally agree.
Okay, we'll leave that there. Kaylee, thank you. I mean, I disagree, obviously, but whatever. 4 minutes into the session, equities look like this. On the S&P, we're down 0.25%. On the Nasdaq, down 0.5%. 5-day losing streak on the S&P. Sarah Hunt of Alpine Saxon Woods warning that earnings estimates are still too high. Consensus estimates still show about 5% growth. It is difficult to see how we get that if we get the recession we all seem to be looking for. And the soft landing that is the best case scenario seems to be predicated on little or no damage to earnings in 23. Sarah, I'm pleased to say, is with us right now. So, Sarah, I had this conversation with Mike Wilson at Morgan Stanley yesterday. We're all talking about it. It seems to be well understood. Why isn't it priced?
That's an outstanding question, because consensus estimates are made up of everybody's estimates that gets pulled together by Bloomberg and by other of the financial press. Why aren't people taking their numbers down? This is not. You see some of the strategists taking their numbers down, but overall, individual company numbers are not coming down, which is what feeds up into that S&P estimate. And until we start to really see that, I think it's difficult to feel comfortable within multiple when you don't know what the earnings is. Forget about not pricing the risk-free rate. We also don't know what earnings are going to be. And I think that 5% growth in next year just seems like a big stretch to me.
So walk me through the arc of earnings next year. They get announced in mid-January. Are you expecting that kitchen sink moment? Jack Caffrey and JP Morgan was talking to us about it moments ago. Is that what you're looking for in early 23?
What's really interesting about the way that 2023 is shaping up is that we've got this narrative now that the first half is going to be very weak and the second half is going to be better. But the first half starts in like 9 days. And unless we get a lot of more weakness in the next month or two, it may be that you don't really see that until you get into the spring. So maybe not until we get first quarter earnings. I expect to see some expectations of full year earnings as we get through fourth quarter, because nobody wanted to give projections at the end of third quarter, but it's going to be hard to pin people down. And I think that the difference is going to be when you start to get into that first quarter, are people still are consumers still buying? Are things still going fairly well? Or does that earning problem come later in the year as opposed to right directly in the first half of it? I don't know the answer to that, but I do know that I'm hard pressed to believe that earnings are going to be as unimpacted as it looks like consensus has right now.
So, Sarah, do you think companies are going to be warning us in a big way in this earnings season? And if they do, is that the tipping point?
I think it's really going to depend on how the first few people come out of the gate, right? We start with the financials, and that's going to have a different, there's been a lot of volatility, so there's been a lot of trading. There's going to be a little bit of a difference there. I think at some point that they will try to kitchen sink it. I'm just not sure it's going to be at the very beginning of the year. And if it is, then that gives us that first half, hopefully catharsis. But if it isn't, then we still have to wait for that earnings shoe to drop. And I think that that's going to be part of what's going to be difficult about 2023.
Sarah, is it still too early to talk about leadership of a recovery trade and what leads it through next year?
I don't know that it's too early, but I think it's difficult to figure out exactly what it is, right? You've seen a big move in the industrials on the hope that, the global economy doesn't have a big recession. I think it's hard to see exactly where that's going to come from. I used to think that it was going to be the profitable technology companies, but they have really suffered a lot more than I expected them to through all of this. And I think that we really need to see what part of the economies do okay. I think that because the labor market is so strong, the consumer stays a little stronger than expected. And this is part of the tension the Fed is feeling now. How do I impact the labor market without crushing consumers? And I don't know what the answer to that is, but we're going to need to find some sort of leadership, and I don't think we have it yet.
So, Sarah, let me ask you a question. This year was all about the change in the liquidity regime, and that played out in multiples. Next year is all about the economy. Do we get a recession? What does it look like? And that plays out in earnings. Take me to the stage after that. Do we get back to multiples at all, or do we just go through multiples, earnings, and then it's a clear pathway?
Well, I think part of the reason that you're okay with higher multiples is that the earnings have been higher. So I don't think that just earnings alone doesn't also impact multiples, because at some point there's an aspect of, I see the earning picture getting worse and worse, and I'm still paying 15 times. Well, that 15 times, that E number has changed. So now I'm paying 15 times a smaller number. I'm not sure that it's easily as clean as that, but I also think that this is where everyone is looking to get through this so that we can see what comes out on the other side. But we're not even through it yet. The Fed's not even finished raising. You just added Japan to the mix in countries that are adding to the tightening of global monetary conditions. And how that plays out through the economy and through earnings is still a question mark. So I hesitate to say that the multiple picture is completely finished yet, because that also ties into interest rates, and I'm not quite sure we're done yet.
Hey, Sarah, wonderful. As always, Sarah Hunt there of Alpine Saxon, words on the latest. Mohammed, let's reset. You and I talked about this a million times this year. I'm going to butcher this, so correct me by all means. I think it was crisis in EM, it was recession in Europe, stagflation in the US. Is that what you were expecting this year, looking out to next year?
Little fires everywhere in EM, not crisis in EM, but little fires everywhere.
Are you still base case stagflation in America next year?
Yes. If deflation part is compared to the 2% target, yes. But we are getting through it. I mean, that's the encouraging thing. We are getting through it, and the damage is not as bad as you would have expected based on history. So that's the good news.
I'm trying to work out where the Fed is in all of that. You heard Sarah say, and I think this is really important, it goes back to something we've talked about all year together. How do you price risk if you can't price the risk-free rate? And we have massive volatility around the risk-free rate as well. It appears to me that people are getting more comfortable with this idea that that's done with now, that maybe they push towards 5, but the next 50 basis points, next 100 basis points of tightening isn't all that important. Let's focus on the cuts. Do you think that's a mistake?
So I think where the mistake comes in is not understanding that when you make a big policy error at the beginning of a process, it's almost impossible to get back into a world of first best. So the Fed made 2 big policy errors coming into this. First, the transitory inflation call, and then not moving fast enough. So now it's forced into a very front-loaded, and it's trying to push markets to a place that markets don't want to go. And that is the issue, is we cannot get back to a first best policy world. So you've got to worry about the unintended consequences of the policy regime. And I think that is what the markets haven't quite understood yet.
What mistake do you think this Fed's making at the moment?
I think they're going to over-tighten, and they're not going to acknowledge that in a world in which the supply side has become the main issue, a 2% inflation target doesn't make total sense. It doesn't mean you change it, but it means...
Well, you know where I'm going next, don't you?
Right. They can't change it. I mean, it is impossible to increase an inflation target that you've missed consistently. Credibility, Argentina tried that. You don't want to go there.
Look how it worked out.
Right. But what they're going to try and do is try and convince us that we can have stable inflation at 3 to 4%, and it's not at the end of the world. They're going to try and do that.
What happens if they try and do that?
I think that's what they're going to have to do, because the alternative of crushing the economy is much worse, and they can't explicitly increase the inflation target. Look, they're in trouble. I wrote an article saying, you've had 2 horrible years for the Fed, and trying to get back on side is not that easy when you've had 2 horrible years.
It's hard to answer this question. If they tolerate 3 to 4 without explicitly changing the target, is that constructive for risk going into next year?
If we can get to a stable inflation at 3 to 4, absolutely. Okay, but you've got to get there.
But that's a real different market paradigm, regime shift, from what we were used to pre-pandemic, isn't it? What's the character of that versus what we've experienced the last 10 years?
It's the reality that the last 10 years was about the demand side, and now it's about the supply side. So I can sit with you and give you a whole list of the functioning of the labor market, the change in globalization, the rewiring of supply chains. It's all about the supply side. And when it's all about the supply side, you've got to tolerate slightly higher inflation. Otherwise, you cause undue damage to economic well-being.
Are you thinking about a new floor in rates then? Because we could go back to 0 repeatedly over the last 10 years. What is it now?
We're not going back to 0.
You said that, but what do you think the new floor is?
I don't know what it is, because I don't know what the recession is going to look like. If we fall into recession, I don't know what it's going to look like. I think this is a very important moment in time where we are not looking at a well-behaved Bell distribution, a normal distribution. We're looking at multiple possible outcomes, and that's what you've got to navigate through. And it's a different mindset. You've got to be much more open, much more humble, because there's so many potential outcomes.
This was great. Do you want this tease? Just got to read it, then pause for the sound, then the sound's going to play, and then you just say that conversation up next. It will be perfect. You've got this. Go on.
Coming up, the drama surrounding Elon Musk continuing.
The biggest overhang on Tesla is Twitter. I mean, it's a $44 billion epic mistake by Musk. This is a Category 5 storm that's Musk inflicted.
Elon Musk is now the hot potato in Washington. That conversation still ahead.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
impressive is Twitter. I mean, it's a $44 billion epic mistake by Musk. Attention focused on Twitter as this twilight zone continues to, go on. And that's really been, I think, 70-80% of the sell-off in Tesla is Twitter-driven. It's hurt the brand of Musk, which has hurt the brand of Tesla, because Musk is Tesla, Tesla is Musk. This is a Category 5 storm that's Musk-inflicted.
The Twitter drama continuing to unfold on Wall Street and on Capitol Hill, both sides of the aisle taking their shots. The RNC resurfacing a complaint, writing in a statement, Twitter has a scandalous history of censoring our voices to benefit Democrats. We demand a re-examination of our complaint. This after Democratic Senator Elizabeth Warren voiced her concern in a letter to the Tesla board. Let's get some team coverage for you. AMH down in DC, Ed Ludlow over in London. Ed, walk us through the latest, please.
Yeah, I mean, CNBC are reporting, citing unnamed sources, that Elon Musk is actively searching for a new CEO of Twitter. I would say not hugely surprising, logical, and in line with what Musk has previously said. Prior to the transaction's close, he did say that he would only lead or be the CEO of Twitter up until the point that he felt it was on its own 2 feet and that he found the right person. Again, John, I reiterate what I said to you 24 hours ago, that I've written to Elon Musk and asked him to confirm if he is going to go through with honoring the results of the poll. We just don't know. Interestingly, reaction in Tesla shares. They did initially pair some of their declines following that report, then accelerated again. They're bouncing down once more. Mizuho is the latest to cut its price target on Tesla, but there was just a single line in that report stating that Twitter deleveraging overhang, with Elon selling Tesla shares, 22 million shares in the month of December alone, 20 million back in November. It's still downward pressure on the stock, and everyone is very much in wait and see mode. But that stock, John, Tesla, now lowest level since November 2020.
AMH, everybody has something to say about this. In Washington, D.C. specifically, Senator Warren wrote a letter to the board recently basically asking whether Elon Musk and his involvement in Twitter was hurting Tesla shareholders. Elon Musk said this: the United States has definitely been harmed by having her as a senator. Lol. Can you walk us through, AMH, how this is playing out in Washington?
Yeah, well, Elon Musk is always finding himself in hot water in Washington, really almost with both sides. They all want a piece of him, and because they really want a piece of what's going on at Twitter. So the latest from Senator Warren was about the potential risks his now dual jobs can pose to Tesla. She also pointed to the fact that there could be also conflict of interest. You have a Tesla competitor like Audi that has advertisements on Twitter. But John, again, this is a long list of complaints from Capitol Hill on Twitter. You had Chuck Grassley recently, a top Republican. He wrote a letter to the former Twitter CEO, now saying it to Musk. Please, we want to know what's going on in terms of security controls at Twitter. You have the RNC re-upping their letter to the FEC in 2010 about the fact that they think Twitter was squashing some conservative media. You also have from the senators like Warner, and you have also from Senator Murphy, who talked about the fact that for Musk to make this play on Twitter, he was able to have funds from Saudi Arabia and Qatar's foreign sovereign wealth fund. There is a number of issues on Capitol Hill, John, and just today the latest is about his dual roles, being a Tesla and a Twitter.
So, Anne-Marie, other than a very long list of complaints, is there anything that Congress can do to change behaviors at Twitter or at Tesla? Or is this just a situation where they complain and that's it?
Well, I think there's two things that we could potentially see, and this is something that we heard from Treasury Secretary, and actually she really backpedaled on this. In CBS, she said she didn't think there'd be a national security review needed for CFIUS to take this review, and then recently, when Yellen sat down at the Deal Book Conference, she said that she misspoke, and there potentially could be some national security concerns. So that's something. CFIUS can look into the national security concerns potentially of Twitter, the money coming in, and potentially if there's like country like Saudi Arabia or Qatar putting pressure on or using their relationships with Elon Musk, who actually was just in Doha. And then, of course, Congress can call him down for questioning. There recently was another letter sent to Musk about the rise in hate speech and the vitriol since he's taken over the top job. Now, Musk has said, all of that hate speech has actually calmed down since he's taken over. But these two Democratic representatives would argue that it actually has not, and it's actually spiked.
AMH down in DC, wonderful as always. To you, Ed, as well, over in London. Thank you. Let's get you some sector price action. This equity market breaking down just a little bit in the last 20 minutes. Here's Abby.
Hey, John. Well, yeah, we are looking at a fifth down day for the S&P 500, the worst 5 days since late September. So there is some serious selling. Not surprisingly, today more sectors are lower than not, led by real estate, consumer discretionary, and tech. All of those sectors being hurt by rising rates. That's the story on the year. There is only one sector this year, as you know, John, that's higher. That is energy, up more than 50%. Take a look at the mega cap tech sectors, all down about 30% or more. Lots of pain there.
What a move year to date. Abby, thank you. Up next, the trading diary and a final word from Mohammed.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
What a moment for Lionel Messi, touching down with Argentina back home a little bit earlier in the last 24 hours. Mohammed capping off. What an amazing career that man has had, and it continues.
Yeah, and I'm so happy for him, and I'm really happy that he's not retiring, because I think he has more to contribute to football.
Just absolutely brilliant. Speaking of football, New York Jets. Just got this question over the Bloomberg Terminal subscriber. You've got to ask Mohammed his quarterback's preference going forward. Zach Wilson, Mark White.
Mark White.
Mark White. That's it, done.
We had a whole hour, but you had to bring it up. You had to bring it up.
In at the very end. You haven't got the opportunity to leave now.
But thank you for having me.
Hey, thank you for being with us. Wonderful this year, Mohammed, and looking forward to covering the market with you through 2023. Thank you, sir. The brilliant Mohammed Al-Arian from New York City this morning. Good morning. This was the countdown to the Open. This is Bloomberg TV.
Connection lost.
Chinese consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions want them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop Meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.